earnings matter. And that's really clear.
There's been a lot of good news priced into a lot of the big tech companies. That said, they really do need to deliver.
It's not all one trade anymore. It's sort of the magnificent 3 or 4.
From a valuation perspective, equities still look somewhat rich here.
We still think that there is room to run in equities, particularly U.S. equities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your morning started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Let's pick it up with one name. Let's get Meta on the screen. Down and down hard, negative by almost 13%. It was down even harder overnight. Is the year of efficiency coming to a close over at Facebook? They're going to, quote, Lisa, invest aggressively. That's a very, very big change of tone over at Meta.
So they had the kind of great highfalutin words, the sort of hopes and dreams that Tesla was promising. And the reaction was exactly the opposite. They didn't want to see this in terms of investors. They wanted to see the dollars and cents, and the year of efficiency continued where there wasn't this great investment that was much bigger than people had previously expected.
Away from the capex numbers, the numbers were pretty solid. Pretty solid first quarter. Revenue increasing 27% from a year ago. I think profit more than doubled. But that wasn't enough. The focus, Annmarie, was firmly elsewhere.
It's why when I woke up, I thought these numbers are pretty good. What would the stock be trading at this morning if they didn't talk about Reality Labs and if they came out and said, actually, we're going to have a little bit softer when it comes to CapEx spending? I love one of the things Mark Zuckerberg said on the call because it felt like he was watching the share price in real time. Smart investors, he said, see that the product is scaling, that there is a clear monetizable opportunity there even before the revenue materializes.
All I can say is this right now is a fickle bunch. Right now, investors are taking back what they gave. They really enjoyed the idea of efficiency. Now you're sort of right-sizing it. It talks about a bar that is a very different level depending on the company. It was a lot lower for the likes of Tesla and Boeing. They could basically hop across it with some nice promises of joy in the future. And here's a company that wants to invest in artificial intelligence. Remember when that actually used to mean something? And people are not having it, even as you pointed out, they had an increase of 27% in their revenues from a year ago.
Well, it certainly means something to Nvidia, and they'll deliver results at the end of May. To Lisa's point, Tesla was down by more than 40% going into the earnings. If you look at Meta was up by more than 30% going into the earnings. There's a lot to talk about a little bit later. Microsoft and Alphabet after the close. Just in terms of the data, US first quarter GDP, 8:30 Eastern time. Jobless claims as well. Kind of the last big data points, Bremo, together with PCE tomorrow morning, going into the Fed next week.
What I'm watching in particular with GDP, I think it's going to be a really interesting print. First of all, how much did immigration really support this idea of an expansion in the employment base without necessarily some sort of inflation? And how much of it's being fueled by government spending? That's going to be an ongoing discussion as we head into the $44 billion of 7-year auctions later this year.
I was going to say, we've got to fund that government spending. So 2-year was decent, 5-year was soft.
Yeah, exactly. It wasn't terrible, but it was softer. And this sort of sets up this idea of, as you get further out on the curve, the longer maturities, do you end up having a harder time really selling this debt?
Let's check out the price of things right now. Equity futures just a little bit softer. We're negative by 0.5%. We can turn to the bond market. Going into that auction a little bit later, $44 billion of 7-year notes. We'll repeat it all morning for you.
Thanks.
Happening this afternoon on a 10-year at the moment, just about unchanged, 463.98. Coming up on the programme, we'll catch up with Ben Laidler of eToro as Meta weighs on US equities. Mandeep Singh of Bloomberg on Microsoft and Alphabet. Those earnings coming after the closing bell. And Julia Coronado of Macro Policy Perspectives ahead of US GDP a little bit later this morning. We begin with our top story. Big tech weighing on equity futures with Meta results disappointing. Ben Laidler of eToro saying this: the Mag 7 remain the most important drivers for another S&P 500 earnings upside surprise. Profits growth is slowly rebalancing away from big tech, but they continue to do the heavy lifting. I'm pleased to say that Ben Laidler joins us now for more. Ben, you say don't fear the recent sell-off. Should I fear this sell-off in Meta this morning?
I don't think so. I think earnings have been great. Actually, I mean, not just for big tech, but also for, across the S&P 500, 80% of companies are beaten. All sectors are running, well ahead of expectations. The problem's the guidance. That helped with Tesla and it's hurt with Meta. I think there's a message in there. It tells us that investors are nervous. It tells us maybe there's more macro uncertainty out there. I have to say, I sort of take that, with the territory, given the sort of setup we had, coming into earnings. But, big tech is important. Magnificent 7 is 30% of the S&P 500. It's going to grow earnings something like 40%. Sorry, it's going to grow earnings something like 40% this quarter. Everyone else is going to struggle to keep flat. So it is important. But, this is one company. We've got, the big guns are coming out tonight. We'll see. I think there's still a lot to play for.
Well, let's talk about the big guns. The other two out of the Mag 7 that report later, Microsoft and Alphabet. Ben, given the setup, given what we've learned from how names like Meta have responded to the numbers, names like Tesla have responded to the numbers, what do you think it means for those two big names later on this afternoon?
So markets are telling us they care more about the guidance. They're concerned about costs. They're concerned about margins. So that's absolutely going to be the focus. I think both these companies have quite a lot of levers to pull, and expectations I think are clearly important. And you alluded to that earlier. So someone like Alphabet looks slightly better set up with expectations lower, with valuations a lot lower than the Microsoft does. But again, we've had two of the two reports so far. They maybe balance each other out. We've got the big ones, a couple of the big ones tonight, and then of course we go into next week where we have Amazon and Apple.
Ben, you said don't fear the sell-off. Do you embrace it? Do you love the sell-off? Do you buy aggressively into it?
I think definitions are important here. I mean, we've barely seen a 5% pullback. Put that in perspective, typically you see over 3 a year. Forget about a 10% correction. Your average intra-year drawdown for the S&P 500 is 14%. So, this is barely a sort of ripple. The only reason we're talking about it is because we've had this sort of remorseless, low volatility, rally since, October. So it could easily get worse. But to answer your question, absolutely. I think the pillars of this bull market are in place. Earnings are recovering. We're still going to get rate cuts, even in the US, especially in the rest of the world. There's a lot of cash sitting on the sidelines, which I think is going to buy these pullbacks, which maybe we've begun to see already. And again, your average bull market, 150% 5 years. I think we're barely getting started.
You said something in there that you were really ahead of. You talked about the Fed put before anybody else did, and we all laughed, and then you were absolutely correct, and everybody came around to that idea with the pivot party. And yesterday, as we were speaking with PIMCO, they were saying the pivot party is over, and that seems to be what the market is sort of suggesting. How is that still your base case if the market seems to be saying, you know what, rate cuts are not a done deal? This is an economy that doesn't need them to keep going.
Yeah, absolutely. I mean, we pushed back the magnitude and the timing for rate cuts. I still think they're coming. But to your point, I think we're just making money different ways. Growth has been stronger. Earnings expectations, have been stronger. That's what's been tested here in earnings season, and it's really important, because of that. But I still don't think we can assume that the Fed is never going to cut interest rates or even is going to hike interest rates. Now, maybe the tail risks have changed, and that's a recipe for volatility, which we've begun to see across asset classes. That's a recipe for, inflation hedge assets like commodities beginning to perform better. But I think that's the market looking at the tail risks. I think we're a long way from that being the base case. As long as rates stay restrictive and as long as this productivity boom continues, US productivity running twice long-term average levels, that's the secret sauce here. If that can continue, we can absolutely thread this needle of strong growth and lower inflation.
Ben, when you're talking about the tail risk, are you talking about the geopolitical concerns that are happening right now in the world?
No, I think that's a head fake. I think the tail risk here is the Fed hikes interest rates. That is the sort of second pillar of this rally, which has been pushed back a bit, has been compensated by stronger earnings. But if you take that out completely, if the market is not pricing in higher interest rates here, it's pricing in maybe a 15, 20% tail risk chance, but we're a long way from that being the base case. And I think if that did become the base case, that would be absolutely negative for markets.
Sure, it's not the base case, but what's your probability of potentially a hike?
I don't disagree with it. A low probability tail risk, call it 10%. The change, though, is it was zero. So I think that's what's been the fundamental driver of the pullback we've had. That's why commodities, are rallying. That's why volatility is up, especially in bonds. But now you have equities and FX following.
So, Ben, let's talk about the so-called cash on the sidelines. The cash sitting in money market funds that a lot of people in fixed income have been trying to get to migrate elsewhere, to credit, further out along the curve. Ben, if the new threat is not lower rates, it's higher rates, why would I move out of this front end anytime soon? I'm just trying to work out why that's a supporting factor now for the bull thesis.
I think it's an incremental support. Markets ultimately trade on fundamentals. The technicals, I think, are important, at the margin. I still think whether you look at, the numbers, whether it's the amount of money in money market funds or just anecdotally, the feedback we're getting from investors, a lot of money missed this, rally off the October lows. And I think, they are very intently looking at any sort of pullback here, even if it's only the 5% we've seen so far.
Ben, can you characterize how bullish you are relative to where you were 6 months ago, since you were ahead of the game when you came out aggressively positive, even as other people talked about recessions that never materialized?
Probably a little bit less bullish since then. I mean, the fundamentals have changed. We're not looking for 6 or 7 rate cuts anymore. Valuations are now above average. Earnings expectations, are higher. I guess I would, I think the outlook for the US is absolutely less good, but I don't think it's bad. I still think you make money in the US. I think the real opportunity is everywhere else, where valuations are a lot lower, where you're going to get early rate cuts, where economies are already weak and much more interest rate sensitive, and will respond to that. So I think the real opportunity here is in the rest of the world and actually sectors outside of big tech. That's where there's room for a multiple re-rating. That's where you have low valuations, which give you an insurance to if things go wrong. And crucially, profit margins are very low and have a long way to rise. So I think you have 2 ways to make money in a lot of these other assets, whereas I think tech's well supported, but valuations are high, earnings are high. How much more can you squeeze the lemon? Ben,
it sounds like you like Europe. Is that right?
Yeah, Europe, emerging markets, cyclicals. Yeah, absolutely. I mean, people have been bearish on Europe for as long as I can remember. I mean, literally decades. Yep. That means that valuations are cheap. That means that expectations are low. Profit margins are depressed. You have a very cyclical, indices, and you have the catalyst coming of interest rate. The ECB is going to cut interest rates in June. They can get ahead of the Fed, maybe not dramatically ahead of the Fed, but that's where the catalyst is coming. And you have an economy which I think is very sensitive to that, much more than in the US. So again, that's your double combination of potentially higher valuations and higher earnings. That's how you make real money in stocks.
Do you worry that 90% of the arguments that you just presented could have been presented at any point over the last 10 years?
Could they? I mean, certainly some of them. Europe's always been cheap, deserves to be cheap. Sentiment's been low. But, if I look at European valuations or FTSE valuations today, they are 20% or 20 percentage points cheaper than that 10-year average. So, yes, I may have been able to make a version of that argument at any point in the last 10 years. But it's A, the magnitude, and B, the catalyst. The ECB is going to cut. Europe does have more debt. It does have lower profit margins. It is just much more sensitive, I think, to these catalysts than the US is.
Ben, enjoyed this. Great to catch up, buddy. As always, Ben Lader there of eToro on the international trade. Let's talk about things all international just for a moment. Dollar yen, 155.60. So yesterday we're sitting around the table. We break 155 and people are talking about intervention. It's coming. 155.60. BOJ's meeting. Let's see what we get.
Well, the obvious intervention is a rate hike. What if they actually intervene from a financial policy or a monetary policy perspective? We're going to be speaking with Kit Jukes later.
Looking
and he
forward
thinks
to it.
that basically it is inconceivable for them to do that. And I'm curious to know why.
Isn't this going to be the snapback? If you were the US administration, isn't this exactly what you would say back to the Japanese if they start complaining? Your interest rates are too low.
Well, they're going to say you have the tools that you can use yourself to get your currency to where you want it to be. But it was interesting, of course, because Janet Yellen did meet with the finance minister and the finance minister of South Korea and implied, we understand the complaint, but I think the administration behind the scenes is probably telling them, you can deal with it yourself.
We'll see what we get from the Japanese. 155.60 on dollar yen right now. Let's get you an update on stories elsewhere. Here is your Bloomberg brief this morning. We can catch up with Danny Berger. Hey, Danny.
Hey, John. President Biden's campaign has said it will continue to use its TikTok account. The irony, of course, is that the president has just signed into law that ByteDance needs to sell its stake or be banned in the U.S. Now, Biden's team, they justified it by saying, look, it's part of a strategy to reach a wide range of voters, which TikTok is one of the rare places that Biden can reach Gen Z and millennial voters, and the ban won't kick in for another 270 days if it does. Now, a transformational deal in the works, the likes of which we haven't seen in over a decade for the mining industry. BHP, the world's largest mining company, has made a takeover bid for Anglo American. This would create the world's biggest copper miner, though whether it could pass through government's approval or not is a different story. Now, forget Meta. This is the best story of the day. Jefferies CEO Rich Handler has sold 65 million shares in the firm itself to buy himself a yacht. Handler said in the statement, "My sale of shares today was a gift to myself and my family, and I do not intend to sell any further shares. I remain extremely bullish on Jefferies and fully committed to helping us continue to build the best independent global and full-service investment bank." It is the first stock sale the CEO has made in his 35 years at the investment bank. And if we're okay with Bezos selling his shares of Amazon just because he moved to Florida, what's a yacht between friends? That's your Bloomberg Brief.
Danny, I don't hate it. I feel like I do exactly the same thing. Love that story. I think so many other people did too. Just a comment on Anglo-American. Copper, the new diamonds. I think this is really, really interesting. You don't want Anglo for De Beers. The Journal's reporting they might spin it off before they complete a sale. You want Anglo for the copper.
And it raises a question about the domicile of the company, too, and what London is going to serve in terms of headquarters for a lot of these major mining companies.
Lots of questions about that. Equity futures right now negative by 0.6%. Up next on the program, Meta's big spend.
The actual quarter looked pretty good, in my view, but the expectation, I think, from most was that they were going to keep those costs in check. And the fact that we're actually not seeing that, I think, is definitely spooking a lot of investors out there.
Meta down hard this morning, live from New York City. Good morning.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Just about squeezing out a third day of gains on the S&P 500 in yesterday's session. This morning we're negative by 0.6%. Under surveillance, Meta's big spend.
The actual quarter looked pretty good, in my view. I mean, you kind of look at the top line growing about north of 27%. That's a good number. They're probably by far going to outgrow everybody else on the digital ad side of things. But the expectation, I think, from most was that they were going to keep those costs in check. And the fact that we're actually not seeing that, I think, is definitely spooking a lot of investors out there.
It's the latest. Meta tumbling in the pre-market after revealing its plans to invest billions more than expected in artificial intelligence. The Facebook parent's revenue forecast also falling short of estimates. Investors now looking ahead to Microsoft and Google. They're due out after the close a little bit later. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, good to see you again. If I'd said to you this time yesterday they'll deliver top-line growth north of 27% and the stock would gap lower by almost 20%, what would you have said to me?
I mean, the only caveat that, as I flagged yesterday, they won't get a pass if, the top line will start to decelerate and they are losing $4 billion on Reality Labs. And look, even yesterday, they called out AR glasses, but then they wrote down inventory in their Reality Labs segment for VR. So it just puts into question, there are no investment markers in Reality Labs, and there is no path to monetization. Like AI is being monetized across all their products. It's making the recommendation engine better, ad targeting better. You can see that. Why not give more clarity around what your plan is with Reality Labs? And I think that's missing.
As you know, Mandeep, the bull thesis over the last 12 months plus, going back to late 2022, was on discipline, efficiency.
Yeah.
Should we be worried about that now after the CapEx figures we saw yesterday?
I mean, the market was expecting a beat and raise quarter. Instead, I think what you're going to see now is the numbers will go sideways because, all the CapEx will get reflected in the gross margin over time. And look, Microsoft is going to come up with the results tonight. They'll raise their CapEx by 40%, and the market will probably cheer that because AI CapEx is good CapEx. I think that's what Meta needs to do, is to kind of separate what the Reality Labs component is versus what the AI component is.
This is important and exactly where I wanted to go, because the way that it was basically cast was this is artificial intelligence spending. So I didn't understand why you didn't see a bigger pop, since nice words work, it seems like, when you take a look at what we saw with Tesla. Do we have any sense about how much is getting funneled into virtual reality headsets in the metaverse versus artificial intelligence?
I mean, we know the segment losses for Reality Labs are still going to be $15 billion this year. And baked into that is some of the write-offs for the VR devices that weren't sold. So basically, they have to write down inventory. And look, in terms of CapEx, you could argue some of that CapEx has an overlap. If you're spending in GPUs, it can be used for developing the infrastructure for reality labs, as well as for AI. But I just question, how do you monetize AR, VR? Are you going to show an ad to people or who are using those devices? Like, what's the path to monetization? Hardware is a very low gross margin business. As I mentioned yesterday, they're subsidizing the hardware. So you have negative gross margins. You don't have a path to monetization in terms of ads. So why are they investing so much in reality labs?
At the same time, they're minting money. And if you're basically buying a stock because you're buying growth, the potential opportunity with respect to TikTok and getting some of the potential users there, the idea that they grew their revenue more than 27% year over year is really substantial. Why isn't that more meaningful to investors that, yes, have already baked in a high valuation, but also could get some sort of boom from the AI investments that they're making currently?
I mean, look, they've got a lot of drivers that look really solid in terms of revenue growth. AI agent is a big opportunity. I think they can create a market of their own in search within the social media platform. So a lot of things that could go for them, which is why investors want them to be focused on the AI opportunity as opposed to focus on AR, VR, because they have so many things they could do. Really, it's unlimited in terms of the surface that they can monetize with ads. So why focus on something that will be hard to monetize?
Mandeep, let's talk about Chinese ads, Chinese advertisers that want to get in front of American consumers. They were a little bit uncertain about the future. Why?
Yeah, well, it's reflected in that wide guidance range they gave for 2Q. So I think a question did come up on the call where they just said, we're watching and, you know, that advertising, that spending could come back. But look, ads are an auction-driven mechanism. So even if Chinese advertisers are not there, there are some other advertisers who can fill in. Ad pricing will take a hit. But in the end, this is the company that has the attention. 3 billion users globally. So where else are you going to go if you want to acquire new customers as a small business?
And potentially that user base can grow if we do see this TikTok ban or divestment. They were asked about it yesterday, and the CFO said, quote, "It's too early to assess the impact." Well, the countdown's already begun. At what point will Facebook come out and potentially say how they feel about this?
I think you're probably going to hear it next quarter because a lot of those creators on TikTok will have to find another home. They will either move to YouTube or they'll move to Meta's Instagram or one of their properties. So you will start to see that migration. And I expect that user tailwind to be there for the next few quarters.
The short videos become absolutely massive. Some of the numbers coming out of the firm yesterday. Reels makes up 50%, about 50% of the time that people spend on Instagram. Isn't that some kind of guide towards what kind of world we're moving towards?
Yeah, look, I think the recommendation engine is powered by AI, so all that CapEx is being utilized in a very effective way, and they are getting that ad targeting. I mean, not only is the recommendation getting better, they're making it easy for advertisers to create their ad campaigns using AI. That tells you something, you know, we will have a lot of productivity from AI. I mean, Meta is the biggest use case out there in terms of what AI can do, and they are actually deploying it very effectively.
Mandeep, this was great. No doubt we'll catch up with you later. Mandeep Singh there of Bloomberg Intelligence with Meta down about 13% this morning. Coming up very shortly, we'll catch up with Michael Hordern of 22V Research as possible sanctions loom over Secretary of State Antony Blinken's latest trip to China. Equity futures on the S&P down about 0.6% on the S&P 500. In the bond market, the 10-year about 464. Lisa, things pretty stable going into that auction a little bit later.
And it has been. I mean, even yesterday, yeah, it was a weak auction, but it wasn't that weak. It seems like there are the buyers who want to come in and buy. It's just a matter of price.
The 7-year auction this afternoon. Before that, maybe setting the tone, the data this morning, initial jobless claims and US GDP a few hours away. Live from New York, this is Bloomberg. Three days of gains on the S&P, just about yesterday. Incidentally, the longest winning streak of the month so far on the S&P 500. It's been that bad. through April. Equity futures this morning taking some of it back. We're down by 0.6%. We're off by 0.9 on the Nasdaq. Meta weighing on that big time, makes up about 5% of the Nasdaq 100. Let's switch at the board and turn to the bond market. Lots to talk about, particularly through the belly of the curve. At the 2-year, the front end of the curve, a little bit earlier this week. Some supply was taken down pretty well. Data was soft, encouraging that bid. 492 on a 2-year. Further out along the curve, things a bit softer on a 5-year auction yesterday. We get a 7-year this afternoon. Looking at the 10-year, just about unchanged. 463.98. I'll go back to the data, Lisa. Maybe setting the tone for that is the data that comes out in about 2 hours' time.
Initial jobless claims as well as the first reading of first quarter GDP. Which do you think is going to be more interesting? I'm actually not sure, given the fact that we do get a sense of how much government funding is fueling some of the gains that we saw in GDP, and just generally how much growth can potentially expand in the U.S.
Show me claims, any deviation away from what we've seen repeatedly over the last several months, which is something like 212. I think it's like 212 on repeat for weeks and weeks and weeks with very little movement on either side of that. I think that just encourages people to believe you're going to get another solid jobs print a few weeks away, a week away.
Which is the reason why it just hasn't been a data point that people have been looking at, because it's basically been flatlining in terms of any kind of change. Honestly, this is an interesting moment because we don't know which data is going to matter. Evidently, S&P Global PMI data was probably the most important data point so far of the week.
There's a central bank somewhere praying for soft data in America. I think you know where I'm going with this.
Yeah.
Turn the board over to dollar yen. The Japanese need some soft data. They need it quick. And they need it not in Japan, they want it in America. 155.61 on dollar yen, positive by 0.2%. It has just been relentless, Lisa, through the year, and much more so through this month.
You know, I was seeing a number of headlines saying that we're heading toward intervention level. We were heading toward intervention level about a month ago. This raises a question, what is the threshold? And are they going to move without what you just said, which is weaker data in the U.S. that will make it easier for them to throw money at this? At this point, again, I want to hear from Kit Jukes. Why is it inconceivable that the Bank of Japan will hike rates if they are so concerned about the depreciation of the yen?
I wonder how much this is weighing on Japanese executives. Bloomberg caught up with the Japanese airline CEO, and they said actually 130 is what we would like, because they go out and they use the yen and they buy things like Boeings and they buy Airbuses, and they said, quote, this is a problem, a quote, big problem right now. And you have to imagine they're calling up the finance ministry and airing some of those complaints the way the finance ministry came to Washington, D.C. to air their complaints.
And they've got to pay for some fuel as well. 155.62 on dollar yen. Under surveillance this morning, shares of Meta plunging on a weak revenue forecast and plans to spend billions on artificial intelligence. The news pulling down tech more broadly, with Microsoft and Alphabet set to report after the closing bell. We gapped lower yesterday by almost 20%. We've come back since then in the pre-market. Looking at Meta, we're down about 13. I wonder if this move sticks through the day. I wonder if it does.
I agree with you, just simply because a lot of this is a knee-jerk. The bar is high. Let's sell. Let's capitalize on gains, because evidently, as you said, the year of efficiency seems to be over. Now, as you dig under the hood, I think Mandeep nailed it. How much is really virtual reality sets and throwing money, good money after bad, and how much is really investment in artificial intelligence?
Exactly, because Mandeep's talking about what we're going to hear from potentially Microsoft and Apple when it comes to this AI spending. He says investors actually like that. What they don't like is this reality labs, the fact that they're subsidizing these Ray-Ban sunglasses, and then how do you monetize that down the future? He says AI does show a path to monetize because it helps improve the core business of these companies. So I think if they came out and potentially talked about, we're going to have a lot of CapEx spending, very little is going to reality labs, but a lot's going to go to AI, potentially we wouldn't have seen this drop.
You're getting some more earnings this morning from Southwest. Southwest, Lisa, look at this headline. Limiting hiring, offering voluntary time off programs as well. These airlines are all in very different places at the moment in this country.
Especially if it's a domestic, lower-cost airline, which is what Southwest is facing. What you're looking at is adjusted loss per share that's wider than people had expected of 36 cents versus the estimate of 31-cent loss. The revenue for passengers was actually lower than expected. Again, the sort of two-speed airline industry of people who can travel overseas in first class and are able to pay a lot more, and then people are going on vacation with their families who are really feeling pinched.
A bit softer in the pre-market. That name is down by 6% in early trading. We mentioned the data. Let's talk about it. The initial read on first quarter GDP in America expected to confirm a booming economy. The median estimate in Bloomberg survey seeing a rise of 2.5%. Personal consumption and initial jobless claims are also due out in about 2 hours' time. The PCE deflator and UMich consumer sentiment survey, that will come out tomorrow going into the weekend. I want to turn to this. Secretary of State Antony Blinken raising concerns over trade and support for Russia on his latest trip to China. Blinken is meeting with communist Communist Party officials in Shanghai before heading to Beijing. Blinken is expected to echo Treasury Secretary Janet Yellen's threat of new sanctions on banks supporting Russia's war machine. Michael Hirschman of 20 TV Research joins us around the table. Michael, good morning to you.
Good morning. Let's
get into this. I heard it from Yellen. We're going to hear it from Blinken. When do we start to see the policy?
Well, I think a sanctions push is something that the U.S. is not going to take lightly, especially on a major Chinese bank. And I think, frankly, the Chinese banks are taking this pretty seriously as well. So I would guess that this move is not imminent, but you have to take the threat seriously.
Is the warning enough for the Chinese banks to change course?
I think for the large banks, Beijing will let them manage their own sanctions risk. I think it's more likely that we would see something that would be one of the smaller banks. Now, that could be still a large bank in absolute terms, but what we've seen with Iran, with North Korea, is it's typically the sanctions risk is really embedded in the smaller Chinese financial institutions.
There's a plethora of issues Tony Blinken is going to want to bring up today, whether it's China bringing in more Iranian crude, whether it's China supporting Russia, if not outright, but through these things like helping them with the materials they need, TikTok, South China Sea. What is the main request they need to ask? Overcapacity. What do you go in there and say, you need to sort this immediately?
I think it is a long list, as you said. I don't think that Blinken is going to carry the water, so to speak, on trade. I think that's really discussion left to trade officials. I mean, clearly he's going to make that point. But I think higher on Blinken's agenda will be China's support for Russia, Iran, and the nexus to the Israel-Gaza conflict. And then South China Sea, you have, a flashpoint that people sometimes sleep on, but is really serious with the tensions between China and the Philippines. That could bring the U.S. in, potentially quite easily in the sense that the U.S. is a treaty ally with the Philippines. So if we see an accidental collision, some kind of miscalculation between China and the Philippines, that issue moves right to the front burner.
How much do you think that the conversation is going to sound something like this? Tony Blinken to the ambassador or even Xi Jinping, we're so much better than the other guy will be, so work with us.
I don't think that will be an explicit part of the conversation, but the election certainly is on something that is on the minds of the Chinese. I think they don't want to see China become any more of the center of the U.S. election than they already are with an issue like TikTok. So it's an incentive for Beijing not to let these issues flare up too much. At the same time, it somewhat limits President Biden's negotiating leverage because the Chinese don't know who is going to be president a year from now. So the election is going to be something that's certainly on everyone's mind, but not explicitly raised in this conversation.
You said that trade is not going to be really the main issue. They're going to be talking about support to Russia and trade with Russia and some of the other sort of global interference with geopolitics on the part of China. How do you divorce the idea of trade from some of those issues at a time where economics increasingly is really determining the geopolitics?
They can't be divorced. And especially if you think about the excess capacity issue, it's one that's really tied to the strategic competition over clean energy. If you look at the export controls, which are a trade issue, right, limiting export of semiconductors to China, a direct link back to national security. So it is definitely going to be part of the conversation. The Chinese, I think, are going to push back quite forcefully on U.S. tech restrictions. They see this, they've been characterizing this as an obstacle to China's development. So it's getting closer to being sort of a core red line issue for China. So it absolutely is going to be part of the conversation. They can't be divorced.
Japan is going to be watching very carefully. Can we just build on this conversation that Lisa started? How do you think countries like the United States will maintain national security cooperation with countries like Japan at a time where maybe economics cooperation is tested? And I will use the word tested. I can think of Nippon Steel, looking at what's happening in the FX market. How do you maintain cooperation in one when cooperation in the other is a little bit fragile right now?
I think for U.S.-Japan, this relationship is really very solid. I think there's a mutual interest there and enough time, spent on the relationship to be able to see through issues like Nippon Steel. The exchange rate, is an issue. I think it's the same issue on the Chinese side, right? Dollar yuan has got the same issues as dollar yen. And there you have the prospect of these geopolitics seeping in there as well. So it's a complicated balancing act also on the Chinese side as we think about these exchange rate developments.
What did you make of what happened last week in Washington, D.C.? What was your impression of the meeting that Japan and South Korea had with the Treasury Secretary?
Clearly, it's showing, interest on both sides in managing these exchange rate movements. It's a complicated task. I think, as you were saying, one of the questions is, when do they intervene? How do they intervene? We've just seen verbal intervention so far. I think, frankly, they're fighting against some pretty strong fundamentals in terms of the strength of the U.S. economy and the prospect that the Fed is going to be higher for longer. So there's limits, to how much FX intervention can do when the mismatch between the fundamentals are that strong.
When you're talking about allies like Japan, I also think of the European Union. How much is Secretary Blinken today going to rely on those allies and the fact that the Biden administration, as opposed to really the Trump administration, has taken a multilateral approach, saying it's not just us, it's a group of us that you're going to have to contend with?
It's a big part of the conversation, and I think the Biden administration really wants and needs the Europeans to step up more on this issue of China's support for Russia and a number of these other flashpoints. On excess capacity, this is even more of an issue for European countries like Germany than it is necessarily for the U.S. economy. On Russia, Ukraine, it's even more of an existential threat to European security than it is to the U.S. So the U.S. is counting on the Europeans to do more. Whether they will do more remains to be seen. President Xi will be visiting France next month. That's going to be a really interesting test to see how forcefully the Europeans are going to push back.
How nervous do you think Tim Cook is in terms of its business, Apple's business right now in China? How at risk are some of the U.S. and, frankly, even European companies that rely on China for their business?
If I'm Tim Cook, I'd probably be more nervous about the macro situation in China, the fact that the consumer remains weak and that there's rising competition, than I would necessarily from the political risk. He's definitely got to manage that. But if we're thinking about an Apple or a Tesla, those are such bellwether companies in China's market that I think Beijing has to be careful about overt retaliation. This is, at a time when China's trying to revive confidence in the economy. A strike against an Apple or a Tesla would really chill the business environment. I think the U.S. firms that are more at risk of retaliation are, less of the brand name marquee names, more closely tied to technology competition. Those are the areas that I think, those companies are more at risk. But frankly, Beijing does not have great options for retaliation at a time they're trying to revive the economy.
Michael, enjoyed this. Thanks for being with us, sir. Thank you very much. Michael Hordern there of 22V Research. Let's get you an update on stories elsewhere. Let's get your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. We have another winner from the U.S. CHIPS Act that was announced this morning. This time it's Micron. It's going to get up to $13.6 billion in grants and loans, which confirms our own reporting from last week. The money will be used to build out new American factories, but the expansion does come with risk for Micron, given the volatile pricing of memory chips that can cause rapid swings between shortages and gluts. Columbia University's governing body is still backing President Nemat Shafik as calls for her resignation grow. Trustees say that they support Shafik in her approach to managing the campus amid the ongoing protests over the Israel-Hamas war. Columbia has shifted to hybrid classes this week after over 100 pro-Palestinian protesters were arrested for violating police orders. U.S. births have declined to their lowest level in more than 40 years. That new data comes from the National Center for Health Statistics. Now, this trend of declining births, it has been happening for 2 decades, and the drivers behind it, they'll come as a surprise to very few. Things like lack of paid family leave, skyrocketing health costs, higher student debt, not to mention a pandemic. But the data do underscore the importance of immigration to sustain U.S. population levels. That's your Bloomberg brief. John.
Danny, thanks for that. A level not seen since 1979. A lot of wealthier nations facing the same issues. Up next on the program, a booming U.S. economy.
The core measure of GDP, final domestic demand growth, which economists call it, that's going to be incredibly strong. We're running at a hot economy here, and it's not really consistent with inflationary pressures further moderating.
That conversation just around the corner. US GDP due at 8:30 Eastern Time. Stocks a little bit softer here. We're down by 0.6%. Yields just about unchanged on a 10-year, 464.19. In the FX market, the euro reclaiming 107.24. The data maybe is going to dictate where this market goes a little bit later this morning. Jobless claims and Q1 GDP. Under surveillance this morning, a booming US economy.
the core measure of GDP, final domestic demand growth, which economists call it, that's going to be incredibly strong. That will be the third quarter in a row that we've gotten core GDP growth of above 3, and that's something that we haven't seen since 2014, absent the pandemic-related rebound. We're running at a hot economy here, and it's not really consistent with inflationary pressures further moderating.
Here's the latest this morning. First quarter GDP due in just over 90 minutes' time. Bloomberg survey calling for an increase of 2.5%. Julia Coronado of Macro Policy Perspectives writing this. It appears that Q1 will also feature another solid gain in productivity. That is particularly encouraging. It means this robust growth is less inflationary, despite the recent disappointments. Nonetheless, a resilient economy adds to the Fed's sense that they can take their time. Julia, I'm pleased to say, is with us now for more going into this GDP print. Julia, let's start with GDP, and then we can talk about the labour market more broadly as well, with jobless claims on deck. What are you and the team looking for? What are you focused on when we get that Q1 release?
So we, of course, are focused on the U.S. consumer. As Tiffany had just mentioned, running very strong, probably around 3%. The overall pace is expected to step down. We're in line with consensus at 2.5%, reflecting that trade is going to take a bigger bite. So that highlights that the U.S. is the outperformer, and therefore imports are outstripping exports, and trade will take a bigger bite than it did in the second half of last year. So, again, I think overall the picture is going to be robust. We do already know, though, that hours worked for the quarter were pretty moderate, about 1% aggregate hours worked growth. And again, that implies with a strong top line that productivity is going to remain very strong, not as strong as second half of last year, but still at or above what we think of as the long run trend. And that's the secret sauce of a soft landing. And so that's really, really key, that productivity continues to be the driver of these strong prints and not a labor market that's starting to tighten again.
Julia, this is important. Let's extend this conversation just on this topic a little bit more. When you identify then the sources of US growth, what's underpinning this boom, does it tell you that this could be more durable than some people think?
Yeah, I do think so. I mean, I've been pretty encouraged by a lot of things that are very different this cycle than last cycle. We see more business formation, business dynamism. That's something that had been lacking the entire expansion following the GFC. So to see that kind of strong business investment, dynamic business formation, and that hot labor market is yielding dividends in the form of better productivity, better matches between employers and employees, and just strong productivity gains. And I do think it's got some legs here. That's one key driver. Another key driver is immigration. We know that there's just more people. When we look at the labor supply backdrop over the last 2 years, it's been incredibly strong and allowed the labor market to cool off despite very strong GDP numbers. There's no sign that that's going to slow down this year. It would take some policy that would bring it down over time. But right now, the flows that we're tracking, and we track monthly flows of workforce visa granting from the State Department. So this is legal workers coming here to work, and it's across the earnings spectrum, across the professional spectrum, from low wage workers to high wage workers. And that flow has just been very strong. We're still playing catch up from the pandemic. And people want to come to the U.S. and work. And so that's been a great driver of resilience and strength, and allowed inflation to come down despite this outperformance.
Julia, you alluded to it. Let's just go back to that. Whether this could end just like that with a policy shift. Are you saying it's a lot harder than maybe conversations like these let on?
Yeah, look, it takes some time to implement policies and for them to take effect. These are not switches that you can just flip. I mean, one of the reasons we've been talking to the government officials about why the workforce visa granting has been so strong in the last 2 years. And, part of it is just these agencies have been restaffed. Some of the processes have been streamlined. There's always been demand, and we've had been seeing increasing delays in processing of applications for workforce visas and green cards. And that process is now working more smoothly. So, these things take time to build up that infrastructure. We've got that infrastructure humming along right now. And again, that's yielding a very flexible backdrop for labor supply.
Julia, one other thing that's been keeping things afloat has been government spending. How much do you think that that's going to feature into the strong GDP print that we're expecting in about 90 minutes?
That's an excellent question. It has been a big source of strength. We've seen full evidence of the infrastructure bill and the CHIPS Act and the IRA boosting spending directly from the federal government, but also through state and local governments. Now, that's one element that looks to be tracking a bit cooler than the second half of last year. A still robust gain. We've got about 2.5%, both at the state and local and federal level. But it is something we're going to be watching closely because that pace is down from a 5% pace in the second half of last year at the state and local level. So government spending has been an important ingredient through all these bills that were meant to increase investment across a range of areas, including infrastructure. And it has been an important source of both growth, Lisa, and hiring. State and local government hiring has been one of the bedrocks of job gains over the last year and really running much stronger. If you look at it in a variety of ways, the state and local government, they were so cash strapped after the housing crash that historically they're at very low levels of employment. They've got room to run. Not only are these federal bills boosting state and local spending, but state and local governments are flush with cash. Property tax revenues, sales tax revenues have been pretty strong. And so they are kind of rebuilding a bit. And that has been a source of resiliency. This is a non-cyclical, less interest rate sensitive sector that is providing a foundation of resilience despite other sectors struggling.
Just quickly, Julia, how durable do you think this government spending is at a time where there's an increasing concern about the deficit?
Yeah, it's not going to last forever. Even, the bills that were legislated, we knew that they were going to have a long tail of several years. You don't deploy infrastructure spending overnight. So we knew that the government, in our forecast, we've had the government adding about 0.5% of GDP for a period of 3 to 4 years, reflecting the bills that were passed. So it's not going to go on forever. And of course, if state and local governments are to some degree playing catch up, and again, the delta on these revenues isn't going to keep being positive, we will see that slow down. So I don't expect the performance of the second half of the year of last year to persist. I think what we're likely to see in this first quarter probably going to be close to the run rate this year, and then we'll take another step down in 2025.
Julia, thanks for the breakdown. Appreciated this. Julia Coronado there of Macro Policy Perspectives going into first quarter GDP later this morning at 8:30 Eastern Time. These are the estimates in our survey at the moment. First quarter read, 2.5%. Previous number, previous quarter, 3.4%. Jobless claims important as well. In our survey, looking for a number of 215. The previous number was 212. That's going into payrolls about a week away, Lisa.
And basically, we've seen this robust growth, which has raised questions about what the job growth could look like given this immigration. I was looking at some data, and it's just shocking in terms of the projection of how many immigrants coming in. I believe that the Congressional Budget Office increased their projection something like 128% in terms of immigrants from 2025 to 2027 coming in.
It was projected to be 1 million. Pre-pandemic for these years, it's 3.3. And what the CBO has now done with this recent uptick in immigration coming into the United States, they actually said that this could add to U.S. gross domestic product $7 trillion over the next decade.
Amazing. Payrolls next week, 246. If you want a sneak peek, 246 is the estimate so far. Previous number 303. It's pretty punchy, isn't it? Still near 250. In the next hour of Bloomberg Surveillance, Chris Harvey of Wells Fargo, Tobin Marcus of Wolfe Research, Kit Juice of SocGen, and we'll catch up with Greg Peters of PGIM. Why this bond market is still in the buy zone? Is that what he says? The buy zone?
Something like that. Yeah. What is that zone? It's like a big target.
I don't know. That's next.
think the Fed does need to wait. The bar probably has become pretty high.
Our forecast is that the Fed is actually going to cut this year, and they may cut as many as 3 times.
We are expecting rate cuts coming into the second part of the year.
I don't think we want a screaming hot economy. We want rates to be stable and we want certainty.
It does seem like, in some sense, the pivot party from December is over.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now. Alongside Lisa Abramowicz, together with Annmarie Hordern, I'm Jonathan Ferro. Check out Meta. We'll be on top of that stock throughout this morning. The name is down by 14% or so at the moment. It had gapped lower by close to 20. The numbers weren't bad. If you wake up this morning and you're like, okay, that must have been terrible yesterday afternoon. Revenue is up 27% from a year ago. Profit has basically doubled. It's a pretty solid first quarter, but when you start to look about the outlook, talk about the outlook, Bramo, CapEx, that's where people start to get upset.
So they believe that capital expenditures will be $35 to $40 billion versus a previous expectation of $30 billion to $37 billion. Doesn't sound so bad. It depends what they invest in. If they're investing in Ray-Bans that can give you access to artificial intelligence, or not even that, virtual reality, not so much. And I think that's what Mandeep Singh laid out for us.
You've been talking about it through the last 24 hours. You can't talk about where this name is now without discussing where the move has been over the last year or so. It was up aggressively going into the print. Compare that to the likes of Tesla, which was down aggressively going into the print, almost like the mirror image of the Tesla story.
It just highlights, I don't want to use this word, I'm going to have to, idiosyncratic each company is, just because you had different expectations baked in. Happy talk was great for Tesla. Happy talk was even better for Boeing, or not even happy talk, just realistic talk. For Meta, not so much. Their hopefulness is met with a lot of consternation for people that want the year of efficiency, that want this feeling of stripping back and focusing on ad revenue and, honestly, capitalizing on market share, depending on what happens with TikTok.
And to Mandeep's point, and I think one of our reporters last night in the earnings call was saying how they were trying to, quote, AIify everything. He says they like that. Investors like the idea of AI because it means you can monetize it and it can come back to the core businesses of, say, better advertisements. What they don't like is the reality labs, the metaverse. How do you make money off of, say, the Ray-Ban sunglasses? Okay, you buy the hardware. But what's the service attached? Nothing. And then you dumped all this money into it.
The year of efficiency has come to a close. We're going to be talking about Alphabet and the likes of Microsoft a little bit later after the closing bell. Before we get there, we need to talk about some numbers. US GDP coming this morning, jobless claims as well, going into PCE tomorrow morning. The last big data slate going into the Fed next week.
I don't even know what to do with it. Honestly, it seems like a lot of people have expectations for PCE and what we get for personal consumption and spending. How big is the surprise one way or another to move the needle right now in a market that seems to be kind of range-bound? I mean, again, I keep going back to the idea of the S&P and global composite PMI data, that moved the needle because you saw hiring come down.
Just a bit of weakness.
Just a bit of weakness. Is that where the bias is right now, that people are going to respond more to weakness, justifying some kind of Fed move? That's what I'm curious to see more than anything.
You've said it repeatedly, convictionless market coming into April. Meta's down 14%. Broader equities, near session lows, we're down about 0.75% on the S&P 500. In the bond market, going into the auction a little bit later on a 7-year maturity, 464.39 is where the 10-year is, just about unchanged on the day. Coming up this hour, Chris Harvey of Wells Fargo with Wall Street's most bullish S&P target. SocGen's Kit Jukes saying the yen could hit 170 this summer. And PGIM's Greg Peters on the risk of another rate hike. We begin with our top story. Meta's outlook dragging futures lower with more big tech earnings on deck. Chris Harvey of Wells Fargo with the most bullish year-end S&P 500 target on the street. Writing this, we expect near-term choppiness related to outlooks and rising rates. Our S&P 500 target is 55.35, but we're more focused on the return profile. Stay in the game, but you need some portfolio hedges. Chris is with us now for more. Chris, good morning to you.
Good morning.
55.35 up from 46.25. That's a big change. Can we start there? What changed?
That is a big change. So we knew we were going to move numbers higher. We just didn't know how much higher, because I didn't know. We looked at things last year and we were expecting the market to be up 10%, maybe 15. And we couldn't figure out, that was pretty good at the time, but we missed the market by 10%. What we figured out is the market's just being a lot more aggressive on how it's discounting. It's discounting a lot further into the future, and it's using a much more aggressive forward multiple. And so when we took that into consideration, we realized, hey, we can get to 270 on 2025. We can use a 2021 multiple, and that gets us over 5,500. And so that's really how we got there. And what we think is going to happen is not the economy is going to be really strong. It's a mix shift. The winners are going to keep winning. And the more profitable companies are going to make up a bigger percentage of the S&P 500, and that's how you're going to get there.
So within this is a big core bet on mega cap tech.
Mega cap tech, but really more profitable companies. A lot of the mega cap tech are those, but it's not every single mega cap tech is a profitable company. But yes, along those lines.
Is there anything in the earnings that you've seen or the spending by said companies that makes you concerned?
No, what makes me concerned is we really haven't learned anything new at this point in time. Consumer, still value-oriented, still selective. High-end's doing better than low-end. Kind of knew that. People like to travel, services over goods and things. We knew that as well. Economy's a little bit stronger than expected. Not new news. What we're waiting for and what we're looking for and what we think is this AI spend, it's not a discretionary spend. And we'll see that going forward. Maybe that's part of what we saw last night. And what we think is, again, you're going to have a separation. You've already had that separation between the winners and losers. That separation is just going to get bigger and bigger and bigger.
The separation has been in earnings returns, but it's also been in earnings.
Right.
Just straight out. We saw Southwest, for example, coming out earlier this morning, underperforming, wider loss. You say people like to travel. There are signs that that's actually being challenged on the margins. We just got results from American Air, similar type of disappointment. Right. How much does this make you shift some of the companies that you like? Is this basically a bet that the cash winners and the AI darlings can keep going, but the broadening out isn't going to happen?
Yeah, so Lisa, there's a lot there, right? If we look at Delta's a lot different than Southwest. And Delta had a lot more positive things. It's a higher end consumer. It's also more business oriented, right? What do we like? What's going to change? Well, the bigger question is we see two trades in the marketplace. It's the momentum trade and it's a reinflation trade. And I think that momentum trade will continue because, again, the winners will keep winning. As far as our positioning, what we want to do and what we've been doing for the last year and a half is we want to barbell communications with something more defensive. Now what we want to do is barbell communications with healthcare or utilities. We want some balance. We want some protection in that portfolio, but we do want to participate to the upside.
If the Fed doesn't cut this year or only cuts once, how do you change your target again?
Don't change it at all.
Really?
Right? Yeah, because the reason is if you go back to 21 when the Fed was way too aggressive and then you roll into 22, you ran into a buzzsaw. Why was that? Well, you were too accommodative in 21 and then you turned everything on its head in 22. Well, you're not going to see that going forward. You're going to see a Fed that's going to cut. It's going to be a multi-year cut, multi-year easing cycle. And that continuity is going to help. What else is backing that up? This secular AI trade is not going anywhere. It's actually broadening out to power, to electrification. And then the M&A story keeps getting better and better and better. So whether it's one cut, two cuts, three cuts, we don't care because it's the start of a bigger cycle.
I know it's no one's really base case, but what if there was a hike? How would that change your outlook?
Yeah, that won't be good. and what we tell people is today's...
But that's the risk of increased U.S. exceptionalism.
Well, I don't know about that. But what I do tell people is if today was your first day on the job, you would not be coming to the conclusion the Fed needs to cut, right? The economy is stronger than expected. We're in a bull market with equities. Credit spreads are less than 90 basis points. The consumer's fine. And while the Fed says things are tight, I see parts where it's tight, but when it's really tight, people don't have to tell you. You feel it, you know it. I'm surprised that the Fed is telegraphing easing as much as it has and why they pivoted in December so hard. That's, to me, is very surprising.
My favourite line of yours over the last few years, brace yourself. I think you might know, you might have guessed. Coming out of the pandemic, I remember in 2020 you said it's going to be spring break for adults.
Yeah.
Did you expect it to last this long?
I did not.
Is it over yet?
It's toward we're late in the cycle. We're toward the tail end.
The longest spring break ever.
It is a long spring break. Has been bad, though.
Well, we're trying to work out what to do with discretionary based on that. And that was ultimately the call coming out of the pandemic. It was spring break for adults, discretionary, go, go, go.
Right.
What is it now?
I think it's more producers over consumers, right? The consumer, again, they've spent what they needed to spend. They've done their revenge spending, right? They're being a lot more selective. They're saying, I'm not going to spend a lot for that. If I can jump on a plane and go and travel, I will do that. But goods and day-to-day things, I've got enough stuff, right? And so now that AI trade, right, that's the secular trade. The discretionary spending is not AI. It's a non-discretionary spend. and it's beginning to build out, right? You have the secondary and tertiary trades, the data centers, the power issue surrounding that, the electrification. And so I think if you're looking for a narrative, consumers, probably producers over consumer, but really it's that AI trade, it's that momentum trade. It's still a growthy market in our opinion.
You mentioned M&A, and I have to go there because it's something we've been talking about a lot.
Yeah.
How much M&A can happen given some of the recent FTC action?
Well, that's a great question. And one of the things we keep saying, one of the things that we think will happen, right? People ask us, how do you handicap elections? What do you do? And the thing that we look at is who's going to control the Senate, right? Who controls the Senate is very important. If the GOP takes control of the Senate, that's much better for equity markets. And I think this time around it's going to be much better for M&A because the regulatory environment is very difficult for M&A and M&A activity. And so if you see that change in the Senate, I think that helps accelerate longer term M&A in the M&A cycle.
So aside from a rate hike by the Federal Reserve, what could crack your confidence in this type of return as we parse through which data matters most?
How long do you have?
We've got time.
We've got time. So right now it's rates. I'm really worried about rates because equity and rates, there is this momentum component where I buy strength, I sell weakness. So you can see rates gap up pretty quickly, right? We're above, I think we're 460 and change. You could see 4 3/4, 5% very, very quickly. The other thing is expectations. Are we seeing people just managing expectations or are they telling us something different? And then the last thing, in the equity market, it's the same thing, right? I buy strength, I sell weakness. Well, a downturn of 3, 4, 5% can turn into a 7, 8, 9, 10% sell-off very, very quickly. So those are some of the things that we're worried about right now.
Chris, this was great. It's good to catch up. It's been too long.
Yeah, it's
good to see you, mate. Thank you. Chris Harvey there of Wells Fargo. Your equity market pulling back by 0.7%. A little bit softer this morning, driven by those earnings yesterday from Meta going into Microsoft and Alphabet after the close later. Let's get you an update on stories elsewhere. Let's get to the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Because we haven't talked about it enough, there are more concerns for investors about Meta beyond the reversal of Zuckerberg's efficiency push, specifically that revenue forecasts were in the mid-range. Now, it does suggest that digital ad prospects aren't as strong as some had expected and potentially sets up disappointment for Alphabet's earnings today. Sophie Lunn-Yates of Hargreaves Lansdowne told me earlier this morning that she is worried about the digital ad backdrop.
There's been a slowdown in ad spending from tech companies in North America and China in particular as well. So just all in all, the global picture for ads is looking a little bit more challenging than I was certainly hoping for.
That conversation on Bloomberg Brief, which is every morning at 5 a.m. Eastern. Now, Southwest shares, those are also getting hit pre-market. Lisa, you mentioned that. The statement this morning, it also included their Q1 results. It shows just how big of a toll the Boeing crisis is having on the industry as a whole. Southwest said that growth is slowing. They'll have to end service at 4 different airports, and they're going to have to limit hiring while also offering voluntary leave. Making matters worse, Southwest is only set to get 20 Boeing 737 MAX airplanes this year, down from a planned 46. Now, speaking of Boeing, CEO David Calhoun says that it is making progress to fix manufacturing issues. He says that Boeing will meet its $10 billion annual free cash flow goal just 6 months later than anticipated. Now, as for the earnings themselves, Boeing burned through $3.9 billion. Shares, though lower this morning, were higher post-market yesterday because, as one analyst put it, quote, well, it could have been worse. That's your Bloomberg Brief. John.
That's how low the bar was. Danny, thank you. We'll catch up with you in about 30 minutes' time. Up next on the program, the president signing the foreign aid bill.
We're sending Ukraine equipment from our own stockpiles. Then we'll replenish those stockpiles with new products made by American companies here in America.
That conversation up next, live from New York this morning. Good morning.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Stock's down here by 0.6%, just about squeezed out a third day of gains yesterday on the S&P 500. I say just. We were positive by not even 0.1%. We're softer this morning off the back of Meta numbers yesterday afternoon. The outlook disappointing you, the spending disappointing you, you being the people who are selling the stock. The 10-year at the moment, 464.60. In the FX market, the euro stronger by 0.2%, 107.23. Did that feel personal?
Yeah, I was like, why so personal? Like you're selling Meta stock.
It disappointed you. It disappointed whoever's selling it.
Were you disappointed?
No, I couldn't care less. I don't hold Meta.
Okay, carry on.
Thank you. Under surveillance this morning, the president signing the foreign aid bill.
We're sending Ukraine equipment from our own stockpiles. Then we'll replenish those stockpiles with new products made by American companies here in America. This bill includes $1 billion for additional humanitarian aid in Gaza. And Israel must make sure all this aid reaches the Palestinians in Gaza without delay.
Here's the latest. President Biden signing a $95 billion package that includes aid for Ukraine, Israel and Taiwan. The package also including language that would ban TikTok unless its China-based parent company divests. Tobin Marcus of Wolf Research writing, quote, "We continue to believe this will likely become an effective ban based on our expectation that Beijing will block a divestiture. Even if Beijing does allow the sale to go through, we expect that they will attempt to prevent TikTok's algorithm from being part of the transaction." Tobin joins us now for more. Tobin, wonderful to catch up with you. I've been going through this over the last few weeks, and I've been asking this question repeatedly. We all have around the table. It is clear the tension's starting to build, the rhetoric's starting to build from the United States towards China. What is less clear, from our perspective at least, is the policy initiatives that will be deployed in the months to come going into November. What are you expecting to see?
Well, I think that for the most part, we've seen the biggest swings that we're going to see. This TikTok ban, we continue to think it's a ban rather than divestiture, as you say, I think is probably the last big thing that Congress will do before they head into the traditional pre-election inactivity. There will be more conversation about China-related restrictions for the future over the summer, but I think nothing will get done. And then from Biden's perspective, from an administration perspective, the semiconductor export controls, I think, are the sort of biggest swings that we have seen so far. Secretary Blinken is in China right now, evidently threatening secondary sanctions on Chinese financial institutions if they don't stop sending, dual-use goods to support the Russian war machine. I don't really think that is going to come through, although it's a very serious threat. But I think that those are sort of the biggest, most confrontational moves that are on tap. And then the last one is so finally getting the long-awaited reorientation of the Section 301 tariffs that we have on Chinese imports. The administration's been talking about this for literally years at this point, but it seems like they're finally on the verge of sort of raising tariffs on autos and EVs and solar panels and a few other things, possibly lowering tariffs on some lower value consumer goods. But overall, we're locked into quite confrontational policy despite the sort of attempts at taking the tone down with China.
Tobin, when it comes to TikTok, the clock has started. What have we learned from, say, Montana when they tried to have this ban that could potentially play out nationally?
Yeah, I don't think the precedent from the Montana ban is hugely relevant to the federal level. So, Montana passed a state level ban last May, I believe. In late November of last year, that was preliminarily enjoined by a federal district court that's currently being appealed. So that case is underway. But a big part of the rationale for blocking that at the district court level was that states don't have jurisdiction over foreign policy. The sort of view of the court was this clearly is a China measure, not a Montana consumer protection measure, and that's not the province of states. But that, of course, does not apply in the congressional context. I think if anyone is going to be making policy about sort of what we as a country want to allow in terms of foreign ownership of U.S. media platforms, it's Congress. And so I think they'll be afforded a lot more discretion by courts than the state was. So I don't think that, really is much of a positive signal for the company.
But do you think it survives litigation in the courts?
I think it does. Yeah, I think it does. They will make a First Amendment argument. But again, in a national security context, courts tend to defer pretty substantially to Congress and the presidency. And I think it's very important that this is a sort of newly passed law explicitly for this purpose. So, the other precedent that people point to, Trump, of course, tried to ban TikTok in 2020. using executive action under a very long-standing law called IEEPA. And in that case, there were specific carve-outs in that law covering, informational materials that TikTok fell under. But again, we're in a very different situation if Congress says sort of, here is the will of Congress contemporarily. We have just decided to do this thing with a national security rationale. I think that's very different than a lot of the litigation that we've seen, under both Biden and Trump, where they're sort of reaching for some obscure provision of an 80-year-old law to try and do what they want to do because they can't get Congress to act. Here, Congress has acted. And I think that that's probably going to hold up in court.
Tobin, do you expect a response from Beijing, some sort of retaliation from China, given what's going on in the United States when it comes to TikTok?
It's an interesting question. I'm certain that we will see something, but I don't necessarily think that it's going to be substantive rather than symbolic. I mean, this question came up a lot in the context of the semiconductor export controls that were first imposed in the fall of 2022 and then tightened, in the past few months. There were a lot of questions about how will they retaliate. And I think the judgment from Beijing at the time was, we have at least as much to lose from the U.S. From any retaliation. So we ended up seeing these sort of token efforts around restrictions of chemicals that are important for semi-fabrication. And I think in this case also, you can easily come up with sort of symbolic retaliatory moves that they could make targeting American companies. Of course, Chinese rules already prohibit sort of comparable American companies from operating within China. So it's not as if there's a sort of direct retaliation that's germane here, since they've long since banned any sort of U.S. social media platform from operating within China. And people pointed to sort of recent moves facing Apple and other U.S. tech companies as sort of an indication of things to come. But I don't think that we necessarily see dramatic retaliation here, because China's positioning themselves as sort of the defenders of free trade, the opponents of unilateralism, the people who are telling the U.S. not to let ostensible national security concerns get in the way of free commerce. And I do think that both reflects how they want to position themselves to non-aligned countries and their own commercial interests. And I think both of those will steer them away from dramatic retaliation.
Tobin, what do clients ask you more about? China and potential retaliation and geopolitics, or Lina Khan?
Lina Khan has been a very long-standing topic of conversation, comes up in a lot of different contexts. I think that's probably relevant to a broader swath of investors, since deal activity across every possible sector is implicated by what the FTC is doing, whereas the U.S.-China tensions do affect some sectors much more so than others, with semis obviously being the sort of foremost example of that. Lots of questions, I think, over the course of the past 3 years about what the FTC and the DOJ are up to. And, we've been thinking a lot about what that looks like heading into Trump also, and getting questions about what a Trump win would mean for antitrust. We tend to think that Trump would steer antitrust a little bit more back in a pro-business direction, but it's not totally obvious, because there are, I think, pressures within the conservative coalition at this point. Kind of populist wing of the Republican Party has been fairly supportive of what Khan at FTC and Cantor at DOJ have been doing. And so I think there will be, at a minimum, a tug of war about that within the conservative movement if Trump wins.
In some ways, it looks like they're on the same page. Tobin, thank you, sir. Tobin Marcus there of Wolf Research. We started the week with this. If you can't get Tapestry Capri done, can you get anything done in this country now?
I mean, this is a really good question. This is a reason why, when we hear from people, including Chris Harvey, he's talking about looking for the M&A wave. Where is it going to come from if you see a lot of them sort of cancel before they get off the ground? A lot of questions. They're doing some really interesting stuff.
Lina Khan, Jonathan Cantor have brought up the highest number of merger challenges since they've been required since 1976. And to Tobin's point, J.D. Vance, Ohio Senator, potentially a VP pick.
Agrees.
The only person he agrees with in the Biden administration has praise for is Lina Khan.
It's pretty impressive stuff, isn't it? Coming up on the programme, we'll catch up with Kit Jukes of SocGen. Lisa's been looking forward to this all morning, and why he's looking potentially for dollar yen to hit 170 this summer. Session lows here on the Nasdaq 100. We're down about 1% at the moment. Bear in mind, on the Nasdaq 100, Meta accounting for about 5% of that index. And Meta is down pretty hard in pre-market trading. Looking at futures elsewhere, on the S&P 500 softer by 0.7%. Lots to talk about just in terms of the earnings. We'll hear from Alphabet and Microsoft a little bit later on this afternoon. In about an hour from now, you'll get US GDP and you'll get jobless claims as well. So here are the scores in the bond market going into that on a 2-year, a 10-year, a 30-year. Yields just about unchanged on a 10-year maturity, 464.81. On a 2-year at the front end of the curve, 492.48. 3 big auctions this week. We've had the 2-year, the 5-year, and Lisa, later we get the 7-year.
$44 billion. It's actually more interesting to me to watch longer duration bonds right now and the sales of them, because that's the uncertainty. Longer term, are we looking at a higher inflation, a higher kind of term premium based on a higher deficit and an exceptional U.S. economy? And this really is a key question. I also am wondering how we respond to this data. I mean, what is going to really move the needle? Is it going to be weak data that actually moves the needle more than strong data that people have basically baked in? Is that kind of where we are right now?
I want to talk about risk mitigation with you too, Bramo, because you've been on top of this story for a while. I want to reflect on a conversation we had yesterday. If you missed it, it's worth going back over. Michael Schumacher of Wells Fargo, echoing comments we've had from Peter Cheer of Academy, that perhaps treasuries won't work, core fixed income won't work as a haven against the dominant risk in their mind, which could be geopolitical risk. And the argument that Mike Schumacher presented yesterday was basically the similar one to what Peter Cheer mentioned, which is if you face increased geopolitical risk, heightened risk, and the response to that is increased defence spending, particularly in places like Europe, does that put more cracks into the fiscal picture in certain countries that need to spend more money? And ultimately, does that prevent that bid from coming into the bond market in quite the same way?
You can broaden that out. Any kind of downturn, what ammunition do you have to fuel it with fiscal spending if your deficit is already as big as it is? So in a downturn, do you get that same kind of flight to safety into treasuries, into boons, into gilts, if basically you're restricted by how much you can spend without seriously weakening your fiscal profile? It's a big concern for a lot of people.
It feels very acute, though, in Germany, because they did a complete 180 when Russia invaded Ukraine. And the fact that they're even talking about really amping up their defense spending, and they have been trying to, is a big deal.
A sizable move in European bond yields yesterday as well. Let's turn the board and go to foreign exchange. Have a little look at what's happening with dollar yen and euro dollar as well. On the dollar against the yen, 155.51. Breaking through that level just yesterday. We'll be talking about that with Kik Juice of SocGen in just a moment. And looking at the euro, 107.27. Just some recent commentary from some of the hawks on the Governing Council of the European Central Bank, suggesting they'll go in June. We'll agree to that. We are not going to agree to a follow-up anytime soon.
And you've seen that pretty consistently, actually. Yes, the hawks are coming out, but you also hear the doves being less confident about some sort of rate-cutting cycle there, too. It's sort of this persistent inflation that's challenging the pivot that all the central banks seem to go under, and it's the pivot to the pivot. And here we are, and we're just trying to understand.
It's a U-turn.
You know, the economists went with that, the pivot to the pivot.
The pivot.
Yeah. I wonder where they got that from.
They're watching.
Got that from Bramo.
Is it two apostrophe pivot, or is it
no
pivot
idea.
squared?
I'm not the grammar police.
It's a U-turn.
Did they give you a check for that, or no? They didn't reach out.
Let's move on.
And you can never know who wrote it because there's no bylines.
That's true.
So you can't write to them and find out. Anyway,
just talk about it on air.
Shady. Under surveillance this morning. Meta's year of efficiency in doubt. Shares tumbling in the pre-market after the company reported slower sales growth and said it will spend billions more than expected on AI. CEO Mark Zuckerberg asking investors for patience. Will they give it to him?
Well, potentially they're not giving him to today, but let's see if this stock maybe makes a turnaround during the rest of the afternoon. I'm looking forward to Microsoft and Alphabet because they're also expected to deliver updates on their own AI efforts. But when they come out, and potentially if they lift CapEx, maybe it's just for AI. And this idea Mandeep has when you don't have these reality labs, this metaverse, venturing into things like hardware with Ray-Bans. If that's set aside and it's just AI, how much may potentially would the stock be up and not down?
I feel kind of bad for Mark Zuckerberg. He doesn't have the same kind of cult of personality that Elon Musk has. You know, Elon Musk can come out.
He's cultivating it.
He's cultivating it with the chain and such like that. But I'm wondering, you know, if he had a little bit.
Jiu-jitsu as well.
Yeah, exactly. He's gotten jacked. So there's this question of, okay, so at what point can he say something and people get excited about it in the same kind of way that Elon Musk does?
$175.2 billion, fourth richest person in the world, according to Bloomberg's billionaire.
Lisa feels sorry for him.
I have the tiniest violin for Mark Zuckerberg.
Okay.
Do you want to take it back? No.
No,
Still
I'm
feel
good.
sorry for him. Okay, good. Let's talk about the data in about an hour. US first quarter GDP data due in about 60 minutes. The median estimate in Bloomberg survey calling for a 2.5% rise over the previous quarter, underscoring the strength of the US economy. We'll also get jobless claims and personal consumption data going into next week. Going into next week, we'll have PCE, we'll have a Federal Reserve decision, and we'll be talking about payrolls next Friday. I just wonder, look, if it took a soft PMI earlier this week to drive a decent bid into bonds in the way that we'd seen, I just wonder how soft a number needs to be to reintroduce a conversation about a rate cut going into summer.
And the implication from the response to that PMI is that the threshold's actually pretty low. So maybe it really, and I'm sorry to do this, maybe it isn't the pivot to the pivot, and that we're actually looking at a Fed that still wants to cut, and that they're just going to look for any excuse possible. I also think you've been really on this, and it's really a smart point, which is if immigration is allowing the sort of macula disinflation and growth, if federal spending is allowing this, well, how durable is that if we could potentially get some pretty significant policy shifts? I think it's a great point.
It's a question, Lisa, we've got to keep asking. Elsewhere, the BOJ, and thank you, that was very kind of you.
Let's go.
BOJ meeting underway with traders watching for possible intervention as the yen weakens past 155. Kit Juice of SocGen says this: the most dangerous period right now is during this repricing of Fed expectations after the break of a big psychological level. If I'm going to see 170, I'll have seen it by the July Fed meeting. Kit joins us now for more. Kit, we've been looking forward to this. Lisa's been excited, not to talk about football, to talk about dollar yen. I promise you some Arsenal time at the end of this conversation. Kit, we went through 150, we went through 151, 2, 3, 4, 5, all the way up, and every single round number we cut through, we had people coming out and saying intervention risk, intervention risk. Kit, what do you think is guiding the Ministry of Finance in Japan at the moment?
I think in part they're nervous about fighting a battle they can't really win. So, the correlation between dollar yen and 10-year note yields is absurdly strong. US yields are moving higher if the Fed's not going to cut rates, if the US economy is going to be strong in data released shortly. If we're going to continue down that way, do they feel super brave about coming in and fighting it? They'll have to come and fight it in a committed fashion. So they've been trying to just say, we're watching it. And the trouble is, in a low volatility grind higher, the people who are buying dollar yen are extremely comfortable. They're not getting squeezed out at all. The people who are selling dollar yen as a big rate levels have just been frustrated and losing money and having a hard time the whole way. And the cheapness of the yen is monstrously evident for anybody who goes and stands in front of Cherry Blossom having their photo taken, or maybe who goes skiing, but it doesn't show up in export numbers and the wider economy in a big enough way. So they're nervous, I think, about going in too early. But as long as they do that at this point, that just risks the market getting the bit between the teeth and taking us to absurd levels. Because in the end, the extremes of these big dollar yen cycles have done that time and time again.
Extremes, absurd. Is there anything excessive or disorderly about 155?
No, I don't think so. I think, look, the first one I really thought about was the one in 95, when we'd moved down in a long cycle to 100 that sort of made sense. And then we went down from 100 to 80 extremely quickly and came back from 80 to 100 almost as fast. We've had a bunch of those since then, but that's disorderly. And at that point, you feel as if this is going to blow itself out and correct itself because it's going to push volatility up. Traders won't hold positions. At the moment, it's a low volatility grind and there's not much stopping it. The carry's still attractive. The message isn't changing. The central bank's not being aggressive enough.
And this is the reason why you suggested that we could even see this cross go to 170 if this just continues as it is without some sort of intervention, which raises the question, why do you think it's inconceivable that the Bank of Japan is going to hike rates at the meeting tomorrow?
Because the arguments they've used in terms of their rate policy was to say, having moved once, was to say we want to see now what's going to happen when we get the full set of spring labour market data. And so they're going to revise forecasts on inflation and on growth. But it makes vastly more sense on that basis that in the next forecasting meeting in October, then they can say we've won the fight on the labour market and we're going in the right direction, and then they can act again. It's hard for them to do it now, except as a knee-jerk reaction to what's happening in the foreign exchange market, and I'm not sure that's how the Bank of Japan thinks.
Is 170 your base case then?
No, 170 is what I'm looking at. This. I don't have a base case in a world where this is out of control. 170 is literally having broken 150. Why wouldn't we go 20 figures higher because I've seen it half a dozen times in my career.
One of the biggest surprises this year has been the dollar strength. A lot of people were expecting dollar weakness as we saw a broadening out in growth and the sense of a global recovery. At what point does it become concerning or stifling in growth economically on a global level if you see this strength continue in the dollar?
I think it becomes a concern when it hurts the U.S. economy, for sure. When the U.S. thinks inflation's back under control and they don't feel the need to be fighting inflation. So a rate-cutting Federal Reserve, it would be happy to see a weaker dollar. If it causes disorderly moves elsewhere, it causes a problem. I mean, you've got to go back in that sense. We had a really, really big dollar rally through the 1990s and the Great Moderation. And as the Fed raised rates or cut rates and raised them again and then raised them again, we eventually caused the Asian crisis, having blown up quite a lot of things on the way, LTCM, Russia, bits and bobs like that. That caused a really big problem. That dollar wasn't as strong as today's dollar, but that move was a longer move up than this one. So you do get to a point where you create really genuinely big distortions and damage. I think from a US perspective, we haven't quite reached those. I think from a Far Eastern perspective, if you ask the Koreans, the Taiwanese and the Japanese, they'd say, we don't like what the dollar's doing.
They didn't like it last week, and there were plenty of complaints in Washington, D.C. Kit, we heard them. We heard the reports of them as well, and the meeting as well that took place with Secretary Yellen. Kit, we know the origins of these complaints. It's US exceptionalism, and it's a market that's taken the view that what we will see is central bank divergence, a Fed that has to hold, maybe even consider another hike, and central banks like the ECB that are going to go through some kind of cutting cycle. Kit, when I listen to the policymakers on the Governing Council of the ECB, though, that's not what I hear. I hear they're going to cut rates potentially in June. After that, I don't know. Can you walk me through this, Kit? So let's set it up. The economies. I understand the divergence. US really good. Europe struggled. Might be seeing a little bit of a recovery begin. People are taking that, pushing it through central banks and saying what you're about to see is big policy divergence. Do you think we will?
No, I think you get less rate cutting in Europe. The stronger the dollar is, the less the Fed cuts rates. And I do think, from where we are now, apart from anything else, we're at the point where the market shock of strong European data is much bigger than the market shock of strong US data. You want to surprise someone, show me some signs of life in the German economy. And so you'll get a bigger market reaction. I think you'll get a bigger reaction at the ECB. The ECB is nervous from the way this has been playing out, but it wouldn't take much for the hawks at the ECB to turn around and say, hang on a second, let's just go one rate cut at a time and see how much we need. So I think this can play itself out in several ways. But I think from a currency perspective, I think it means that although the dollar's going up, it's not going up forever. I think from a policy perspective, there's some divergence because the situation is so different between the two sides of the Atlantic. But it's not going to go on indefinitely. We don't get huge divergence.
Kit, got it. Here's the appearance fee. I'm happy to pay it. Arsenal Football Club, top of the league. Did you get it done?
I hope so, but I'm watching like everybody else and just loving the ride.
Kit Jukes of SocGen, congratulations. Kit, thank you. In the stadium in the last couple of days, watching Chelsea get absolutely decimated and Liverpool fall apart recently as well.
Yeah, really?
Yeah. OK, we'll let that go.
Arsenal Chelsea, unbelievable. 5-0.
Abramo,
well,
Liverpool falling apart.
Let's just move on.
If you're wondering why, things might get more bearish in the weeks to come if Liverpool don't win the league.
Inter Milan's looking for a loan, so let's talk about that.
Not my team.
I know. It's the other side, so that you don't care.
No. Equity futures right now on the S&P negative by 0.7%. Let's get to your Bloomberg Brief with Danny Berger. Hey, Danny.
Let me just add go Blues, and then I will move on. American Airlines, they are expecting strong second quarter profit, even though it is coping with still high fuel costs. While competitors have pared back their domestic flights, American has been leaning in, especially in its Sun Belt hubs. It also issued a higher than expected outlook. It's an early sign that that very strategy is paying off because consumer demand for travel is there, but perhaps mostly confined to domestics and near international routes. Ford shares trading higher in the pre-market trade, 1.8%. Work trucks and vans enjoyed a white-hot demand, as the CEO put it. It also managed to keep its EV costs in check. Ford is also on track to achieve a feat that would be the envy of any Tesla shareholders. That is more affordable EVs priced between $25,000 and $30,000 that can turn a profit. In the first quarter, however, Ford did rely on the good old-fashioned business of gas-fueled trucks and SUVs alongside its hybrids. Now, the CEO of the world's largest sovereign wealth fund told the Financial Times that he thinks Europeans are less ambitious and don't work as hard as Americans. Probably hard for European to admit. Norges Bank CEO Nikolai Tangen made the comments in the context of his growing investments in the U.S., which are about half of his equity portfolio. He said that Americans are more willing to accept mistakes and take risks, saying, you go bust in America, you get another chance. In Europe, you're dead. That's your Bloomberg Brief. John.
Danny, I think we've got to introduce him to some college grads in America and see if he changed his opinion. Danny Berger, thank you.
And this
Come on, we have to go there. Come on.
Well, I mean,
easy. Nikolai Tangen, can we just say, every time he comes on with us, just wants to talk about the numbers, where we're investing, we invest in everything. It's super dull, super boring. And then he says things like this in his own podcast as well. He's tremendous. It's fantastic. Want a little bit of that next time he makes a Bloomberg appearance.
Nikolai, please come on and talk to us about the divide in the culture between
Loosen
the US
up and, tell us what you really think.
We'll give him a half hour.
About Europeans.
About how we're just not very ambitious.
Apparently, the Europeans are not ambitious. The Europeans might say they've got that work-life balance down in a way that the Americans don't.
He actually addressed that. I should be careful about talking about work-life balance. But the Americans just work harder, maybe at the expense of some other aspects of
some
life.
Truth in that.
Yeah.
But by age group, I think it's changing in this country.
Well, what about European graduates?
I think it's changing in this country. European graduates are like 30 years old. That's the difference. Stay at university for 10 years and live at home.
So that's the way to do it?
Oh, without a doubt.
Yeah.
Live with the parents in Italy till you're 35.
That's not happening. They're getting kicked out in my home.
Up next, the risk of a rate hike.
As long as there's no urgency around cutting, then you can have these discussions about, are we really restrictive enough? How long do we need to stay restrictive? And you wait for the data to show you something. That's where we are now.
A conversation up next, live from New York. This is Bloomberg. Equity futures down 0.6% on the S&P 500. In the bond market, yields just about unchanged, 464.81. Under surveillance this morning, the risk of a rate hike.
When we get strong activity data, they are telling us that probably doesn't push them to hike, right? That probably doesn't push them to actually move more restrictive in terms of policy rates. But what that does do is it really reduces any kind of urgency. As long as there's no urgency around cutting, then you can have these discussions about, are we really restrictive enough? How long do we need to stay restrictive? And you wait for the data to show you something. That's where we are now.
Here's the latest, a fresh read on US GDP coming at 8:30 Eastern Time alongside jobless claims as well. Traders continuing to push back rate cut bets, with some even suggesting the Fed could make another rate hike. Greg Peters of PGIM saying this in the FT: I think it's completely appropriate to factor a rate increase in. I feel much better about the market pricing that in versus the start of this year when it was just cuts in extremis. Greg joins us now for more. Greg, you've talked about the bond market being in the strategic buy zone. Is it still in the so-called strategic buy zone?
I think so, Jonathan. I think, rates being higher is the story here. If you rewind the clock, January, November last year, there was so much bullishness around rate cuts. And I actually felt that was really the worst thing from a bond market perspective, as I think ultimately at the end of the day, the yield is what matters. The yield is what wins. And yields remaining high, I think, really continues to act as a tailwind for the bond market.
Greg, when yields were 2%, it was hard to get people interested in fixed income. I think people have been conditioned by that, the pre-pandemic bond market that went on for the best part of a decade, and that conditioning is sticky. Do you see clients shaking off that psychology? Have they got rid of that? Have they moved on? Do they understand the opportunities in front of them in fixed income?
I think they have, but there's definitely a recency bias. Investors have been jaded by this extreme central bank dominance that we've lived, under the past decade or so. So I do think it's washing away. What holds investors back ultimately is the volatility. So as you see volatility in yields and just kind of markets broadly, it's hard to really alter your asset allocation scheme meaningfully. So what you need to see, somewhat perversely, is less fall in order to attract much more in the way of investment flow.
What's the thesis, Greg? Is it basically just simply a carry trade in a way that maybe people hadn't experienced during the years of monetary oppression? Or is this something that you can get behind the idea of rate cuts eventually and a bid into treasuries in some sort of downturn?
Yeah, so Lisa, I think it's a twofold benefit. The first benefit is just simply the fact that you are earning more in yield, and yield matters. That income in the door matters and matters a lot. That's the first thing. The second is if we do, in fact, hit some kind of economic speed bump or a recession, however you want to define it, there's actually scope for rate cuts. And so I'm not calling, cuts back to zero or what we've seen before, but, at 5% level, there is room, and having duration in the portfolio provides that protective quality that really was missing the past several years pre-pandemic and immediately post-pandemic.
I understand that for, say, 5 years. But for 10 years or 30 years, when you start talking about that level of duration, I start to wonder about the argument that we keep hearing from the likes of Peter Scheer saying, how much more can the United States borrow to help the economy fiscally during a time of difficulty? Does that kind of lever get pulled and then all of a sudden make treasuries less of a haven bid than they have been in the past? What would your response be to that?
Yeah, so I think that's a narrow focus of the world. So if you look at debt levels, they have increased globally, right? Post-pandemic, you've seen countries really start to spend. So I think there's this isolation type of examination here. And I think that this misses the bigger picture. That's the first thing. The second thing is, I think the U.S. is winning here. There's higher growth. Inflation has come down pretty meaningfully. So I think there's a real strong story for the U.S. No doubt, though, what investors are looking for is an off-ramp on spending, and we're not seeing it. So there's a lot of talk, a lot of chatter around the deficit. I think ultimately, though, the U.S. and U.S. rate market is the place to be, particularly in a time of crisis. And I think you'll see this perverse outcome where if you do have this kind of global swoon, you'll see more demand for U.S. Treasuries, not less.
Greg, just work through that an extra step. Let's say you get the economic downturn. What does the deficit look like in that world? What does that gap out to? Because if we're running something with a 7 handle at the moment with GDP growth like this that we're going to see at 8:30 Eastern time, what kind of numbers are we going to be talking about?
Yeah, so I think that is the challenge ultimately. So you don't have the same kind of fiscal room to spend in the time of a recession. That puts more pressure on central banks, which I think actually helps out treasuries a little more, actually. But you're quite right. And the way I think about it, and we think about it at PGIM, is that it actually means that the recession probably is not going to be as shallow as what many predict, right? Because you don't have that fiscal lift, which is so crucial to helping the economy find the bottom. So in my mind, you'll see a slightly harsher credit cycle, a longer duration type of recession, and an overall harsher recession, I'd say.
Interesting. Greg, really interesting thoughts. Thank you, sir. Greg Peters there of PGIM. The last one there, I find fascinating on the depth and duration of a potential downturn, given how constrained fiscal might be in the next downturn.
This is an argument people have been making for a while, that essentially because the United States incurred so much debt during good times, how much does that really constrict their hands in bad times? There is a sort of perversity that I keep thinking about, which is if there is a downturn and the Fed cuts aggressively, well, that can make the deficit a lot cheaper. I mean, that might be what you need, in order to term out the debt at lower rates. I mean, this is sort of the difficulty in understanding exactly how this percolates out. It isn't just a clear line in the same way that it would be for personal finance.
You used to say this about Japan, careful what you wish for. You get the growth, you get the inflation, the high rates with it. Where does that leave things? Right.
Well, I mean, again, it's hard to sort of game this out. Is high inflation and longer high growth, is that a worse scenario right now for the deficit?
Coming up on the programme, Bob Dole, Crossmark, the third hour of Bloomberg Surveillance with George Ferguson of Bloomberg Intelligence on the airlines. We've heard from Southwest and American this morning. We'll catch up with Marina Urici of T. Rowe Price and Stifel CEO Ron Khrushchevsky. All of that in the next hour, right here on Bloomberg TV.
earnings matter. And that's really clear.
There's been a lot of good news priced into a lot of the big tech companies. That said, they really do need to deliver.
It's not all one trade anymore. It's sort of the magnificent 3 or 4.
From a valuation perspective, equities still look somewhat rich here.
We still think that there is room to run in equities, particularly U.S. equities.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The higher you climb, the bigger the fall, apparently, when it comes to stocks. We were up by something like 40% on Meta. Going into the earnings, we're down by 15% in the pre-market, going into the opening bell about 90 minutes away. How does this set us up for Microsoft and Alphabet a little bit later on this afternoon and on to next week, Lisa, for Apple, for Amazon?
I wasn't sure where you were going to go there. The higher you go, the harder you fall.
I wasn't starting a therapy session.
Look at this, like the way that the morning's going. We could do that. What it means is that, honestly, Meta was probably the highest flyer, apart from NVIDIA. So it had the most to fall, if we want to go through that. And we can talk about how sorry we all feel for Mark Zuckerberg and the lack of maybe the same kind of star power that Elon Musk has when it comes to some of his prognostications. For Microsoft and Google, it seems like the bar is equal weight, if you want to say, because basically you've had gains, but these have been the darlings of the AI trade, and they have a chance to really deliver on that and show the application going forward.
Meta's been a darling of this equity market for the last 12 months plus, since the back end of 2022. Big part of the bullish thesis was the year of efficiency. Mark gets it now. It's about discipline. It's not about spending. Is that year of efficiency coming to a close based on the comments we got from yesterday, which include invest aggressively in AI research and product development efforts? That didn't go down well yesterday. I wonder if we sort of learn to love that a little bit more in the days to come.
Here's the interesting thing about this earnings cycle. Every earnings report is different, and the bar is different for every single company. You hear this sort of efficiency discussion from certain companies that are talking about reducing costs in order to support revenues that are coming in lower. And then when it comes to, say, Elon Musk, they're spending on robo-taxis and other things, and just the promise of it is just fine. With Google and with Microsoft, the problem is investment is rewarded if it's in the right thing. If it's in the right kind of durable AI investment, people will reward it.
This is what Mandeep was saying. People like the AI story. They're not so hot on the Reality Labs and the Ray-Ban story. Mark Zuckerberg yesterday on the call, though, said smart investors, potentially those that are buying, not selling, smart investors see that the product is scaling, that there is a clear monetizable opportunity there even before the revenue materializes. But what investors are saying is, when you look at things like Reality Lab, where is that monetization? Because it hasn't materialized just yet.
Not the only focus for us this morning. We'll be talking about GDP in about 28 minutes from now. US GDP, the estimate at the moment, 2.5% in our survey. The previous quarter, the number was 3.4. So really punchy stuff, and looking for some of that to continue in the first quarter based on the information we've already had. If you look at jobless claims, Lisa, the estimate 215, previous week 212. That's your setup for 8:30 Eastern time.
How much of a leading indicator is this? I remember when people last year were saying, this is what you have to watch, and if the labor market's going to crack, this is going to tell you first. Is that still the path of travel? I don't have a sense of it. I get the sense that people are kind of dismissing it. It's sort of all of these data points get dismissed until suddenly they come out with some massive aberration, and then we focus on them for the next 2 months.
Does this sound like a crack? 246,000 for next Friday, which is the current estimate in our payroll survey.
The argument could be, why isn't it 600,000 if we're talking about a wave of immigrants, right? This is basically where we're at in terms of resetting the bar. But no, it's not showing signs of cracking, which is the reason why people are kind of pricing out rate cuts.
Look at the way economists have been reforecasting GDP based off when the CBO came out with the immigration numbers. And the CBO is saying, now that we recalibrated with this type of immigration, 3.3 million as opposed to 1 million added to the U.S. economy, $7 trillion over the next decade is what they see in growth.
This cycle has been so difficult to read, kind of making it up year to year, aren't we?
Day to day.
Ridiculous. Just nonsense half the time. Equity futures on the S&P 500 shaping up as follows. Equity futures negative and pulling back off the back of those Meta numbers. We're negative right now on the S&P by about 0.7%. In the bond market, yields a little bit higher by a single basis point. On a 10-year, 4.65. And in foreign exchange, the euro slightly firmer, 107.19. Coming up this hour, we'll catch up with Crossmark's Bob Dole on why he thinks a soft landing is unlikely. Blarina Urici of T. Rowe Price reacting to US GDP data, and Stifel's Ron Krzyzewski on why a rate hike could still be on the table. We begin with our top story. US GDP data 30 minutes away. Crossmark's Bob Dole saying this: equity markets have stumbled modestly because of yet another pivot by Fed Chair Jay Powell. The odds favour an equity correction or consolidation rather than a transition into a bear market. For now, the economic and inflation backdrop is not consistent with rate cuts. Bob is with us for more. Bob, good morning.
Howdy.
Consolidation versus, say, dipping into a bear market and bear market territory. What's the distinction between the two?
Distinction, of course, is amount of decline and, of course, the macro data behind it. As you all discussed, economic data is pretty good. In that environment, it's unlikely we see the eyes of a recession anytime soon and therefore a plain old bear market. So we're way overbought, maybe not in the short term, but we've had that almost 30% rise from the Fed pivot announcement on Halloween until the recent high. It's time for just a little rest. Markets get tired, just like you and me.
When you say overbought, and I'm tired too, are you talking about the index level on the S&P, a specific cohort of names, the big tech players? What are you talking about specifically?
Yes, all of the above. I mean, the breadth of participation certainly improved. It's not what a lot of technicians would like to see. And as you're pointing out in the earlier conversation, for these high-flying, big attention names, if the numbers don't come through and the verbiage isn't perfect, you spill back. Take Meta. Down, yes, but look at it over the last 6 months, 12 months. It's still been a monster stock.
Mike Wilson was on the show of Morgan Stanley a couple of days ago, and he was talking about how difficult it is to call any kind of index level because this has been a story of specific stocks, and we see that in the earnings. The bar is different, the types of guidance is different, the response is different. How has that changed the way you approach investing?
Much more stock specific. Take the Magnificent Seven. Last year, they all went up. We get to the first quarter this year, and you get Apple and Tesla down a double-digit percentage and some up a double-digit percentage. It's not a stock market, it's a market of stocks, as we often say. But that's even more true now.
So for years, that was the opposite. It was all just riding the market, riding the Fed, riding central banks. How prepared are investors for this type of environment when they got rid of a lot of their single stock analysts? They went with indexed products. The banks cut back on that. And now we're focused on each individual earnings report and scrutinizing every line.
Great question, Lisa. I think investors are not particularly prepared. But look, the next 5-10 years, stocks are probably not going to grow double-digit percentage. And therefore, if you're going to get a double-digit percentage, you've got to be in the right stock. So doing specific analysis, when interest rates have normalized, which they have from that zero we had roughly for a decade, that's an environment where active managers and stock picking should do better.
So right now, are there any themes that you can pick out in the earnings, the early earnings, about just some of the overweight that we've seen, the conviction in energy, the sort of questions around consumer discretionary? How have you been shifting your view subtly around the edges?
So financials and energy still are the bulk of the portfolio from an overweight standpoint. But I would emphasize some common factors: earnings persistence, earnings predictability, cash flow. I have no names in my portfolio where I think the PE is going up. If I get that, that's gravy. Valuations are full.
You talked about oil prices, and you like energy as the backdrop. What is oil prices, you think, going to do when it comes to, say, earnings, corporate profits? Are they going to be passing on potentially, if the input costs are going to be so much higher, are they going to be passing that on to the consumer?
Absolutely. That's part of the problem. It's part of the squeeze we're starting to see at the low end of the consumer. No longer having excess cash from COVID, beginning to go into their credit card balances, even some evidence of raiding 401ks. This is not sustainable and not healthy.
So you don't think the consumer is as healthy as some people think and say?
Agreed. Overall, still good shape. Top end, great shape. Down the bottom, we're starting to see some deterioration, and that will spread over time.
So you talk about the possibility of some sort of rate hike. What would that do to sort of shift this stock-specific type of environment into a market that definitely had a direction?
It would not be such good news, as you can imagine, Lisa. Look, I don't think the Fed's going to raise rates, but out the curve, we've already seen the 10-year, for example, move up to 4.65. Could there be more upside there in an ebullient economy? Absolutely, but I think the Fed's got to try to buy time here. They're between a rock and a hard place.
You mentioned the consumer. Savings down. Lending standards are tight. This has been true now for quite a while, and things seem to be holding up okay. The word we heard yesterday was the word polarization. That was from Kering. They were complaining about Gucci sales and blaming it on the polarization of the consumer worldwide. Just what is happening with the consumer in America? How are you playing discretionary themes at the moment?
So top end, love the stock market gains, appreciation of their real estate. Most of them are working. They've probably gotten a raise. They're happy. They're spending money. But you go down the other end. I mean, the number of people that are working 3 jobs, most of them working 2 now. 2 jobs down to 1. Government doesn't measure all that stuff real well. But down under, we're starting to see some deterioration. And that will only slowly spread over time. Look, I'm not saying a cataclysm's coming, but I do think we will see more pervasive consumer weakness.
We're just trying to work out how to invest around it because, as you know, discretionary on the S&P 500 has the EV factor. It has Tesla as a big weighting in that. What would you strip out from the consumer bucket right now, and what would you get exposure to?
So I think the top end of the consumer in pretty good shape. Where you're high economic dependence, I think you've got to be careful. And then you stick with those names that have the high, consistent earnings, which is not just in the consumer space. Takes you to some financial service companies. Yeah, some consumer names are reasonably programmatic in terms of their earnings, but not a whole lot of them.
Bob, this was great. It's good to see you.
Thank you.
And congrats, buddy, on the CEO role.
Thank you,
I missed that. We haven't spoke for a while. Congrats. It's a serious congrats. Of course it is.
Thank
Shouldn't
you,
be,
sir.
I think. Bob Dole, across the mark. Bob, good to see you. Thank you, buddy. Let's get you an update on stories elsewhere. Let's get to the Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Biden's campaign has said it will continue to use its TikTok account. The irony, of course, is that the president has just signed into law that ByteDance needs to sell its stake in TikTok or be banned in the U.S. Biden's team justify it by saying it's part of a strategy to reach a wider range of voters. TikTok is one of the rare places that Biden can reach Gen Z and millennial voters. Let's get a quick check on Meta shares this morning, down more than 15%. The fear is that Zuckerberg has backtracked on what was supposed to be the year of efficiency as he asked investors for trust and loyalty. Now it's Microsoft's turn to prove that it can monetize AI. Earlier, I spoke with Nancy Tangler of Lafler Tangler Investments about the tech giant earnings.
I think you can argue that he hasn't learned his lesson. We've been here before. You know, we're the CapEx for the metaverse, and now we're in AI chat box spending. Whereas I think with Microsoft, the use cases are multiplying in generative AI.
Similar sentiment among many investors this morning. You can watch the Bloomberg Brief every morning at 5 a.m. Eastern. Now, David Einhorn, as many will remember, earlier called this year the stock market fundamentally broken, and his Greenlight Capital is now struggling to outperform that broken market. The fund returned 4.9% in the first quarter. That compares to 11% return for the S&P 500 Total Return Index. That all according to an investor letter. That letter repeated Einhorn's qualms that passive money and systematic strategies have caused investors to overlook valuations. Greenlight also added that there was, quote, negative alpha in our long book and positive alpha in our short book. Surely not what they intended. That's your Bloomberg Brief, John.
That note earlier this year was absolutely fantastic. Danny Berger, thanks for that. We'll catch up with Danny in about 30 minutes' time. Up next on the programme, Boeing weighing on airlines.
I think we're now getting, with the new management team in place, I think we're going to hopefully see the end of these production challenges in Boeing.
The straight talking Michael O'Leary. Anyone better than that in the airline business?
Absolutely not.
Just absolutely
Honestly,
fantastic.
I love it.
The best. A conversation up next. This is Bloomberg. Equity futures on the S&P 500 down here by 0.7%. Yields a little bit higher on a 10-year. 465.43. About 15 minutes away from US GDP. We'll get some jobless claims as well. That'll set us up for tomorrow when we get PCE and UMich going into the weekend. Coming out the other side of the weekend, Federal Reserve decision Wednesday. Then straight into payrolls for the month of May. May is here. It's just around the corner already.
Which is the reason why June is looking less and less feasible. July is the new June, and how soon is that going to be September? And then we can start talking about the silly season down in Washington.
I think we're already talking about December, aren't we?
Yeah, exactly.
Is the date on the calendar for cuts?
Well, if that's the case, how far does that get pushed out? And then how does that really change the equation at a time where any soft print seems to be giving people extra fuel to possibly go buy?
Yeah, we mentioned this. If you're just joining the programme, welcome. We said earlier, what would it take to restart the rate cut conversation again? Maybe not June, but for July. How soft would the print need to be?
You know, I've heard mixed things right now. I think probably a lot of people sense that there is dissent right now on the FOMC. you could make an argument on either side that they want to get one in and then they don't have to do it anymore for the rest of this year, and they want to do it further ahead of the election enough to not be considered political.
Lots of data over the next week or so. Under surveillance this morning, Boeing weighing on airlines.
We're seeing optimistic signs. I mean, we've seen aircraft now being pulled from the hulls, being moved from Wichita to Seattle, but without any defects being carried over. I think that's a good sign. It'll speed up the manufacturing process in Seattle, and I think we're now getting, with the new management team in place, I think we're going to hopefully see the end of these production challenges in Boeing.
Here's the latest this morning. Southwest shares sliding. The carrier ending service at 4 airports as Boeing reduces its aircraft deliveries for the year. Meanwhile, American Airlines expecting strong second quarter profit, even as it deals with high fuel costs. The carrier saying it's reaping the benefits of its focus on domestic routes. George Ferguson of Bloomberg Intelligence joins us now for more. George, when you look at the airlines at the moment, who's actually got a Boeing problem and who's just got a customer problem?
So Southwest is one that has a Boeing problem. American's got a bit of a mixed fleet, so I think they have less of a Boeing problem, but there's probably a little bit of interruption in deliveries. United is a big Boeing customer. They've got a Boeing problem. Delta doesn't. They're an Airbus customer. And then a lot of the small, low-cost airlines in the country, Frontier, Spirit, JetBlue, they're all Airbus shops, so no problems there. Although some of those are struggling with the geared turbofan. The geared turbofan engine built by RTX, Pratt & Whitney, that's going through an inspection program due to some parts that may have been faulty, and that's taken a bunch of airplanes out of service this year. It will be into this summer. Less of an issue, I think, than the Boeing problem for the U.S. market, but there's problems all around, I guess, right now in U.S. aerospace.
This raises an execution problem, an execution question. Who's dealing with it best? Let's do Southwest versus United. Who do you think is dealing with it best?
I think United is dealing with it best. But United's dealing with it best only because United has much more of a premium product in their airplanes. And as I look at the results that came out this morning from American and Southwest, American may tell you that second quarter is going to do much better, but the yields, the price the customers paid per mile they flew, were actually quite poor for the first quarter, surprisingly poor compared to United and Delta. Domestic yields down mid-single digits, while the Delta was flat. United was up a bit. So, there's other things going on besides just airplanes in the marketplace. I think a lot of it is premium versus basic economy, what's going on right now in the airlines.
Let's go there. This question of how much can you pass along higher costs to the consumer, and there's definite pushback among certain consumer types. I am wondering how much this really does crimp airline profits if oil prices stay where they are or go higher, simply because they cannot pass that cost along to their consumers.
Yeah, agreed. Look, right now they're not passing the costs along. If you look at all these airlines compared to the year prior, performance is down, and fares don't look to have been improving again in 1Q. They may tell us there's more demand coming in 2Q. Let's wait and see it. We're not at profitability we saw pre-pandemic, and as you said, if fuel prices rise, I don't see the consumer giving it here. They're not going to give it with just because fuel prices are rising. They're not going to be willing to come out and give the airlines more money, I think, to fly. It seems like the consumer's a little bit tapped out. Again, maybe the lower end consumer is.
Do these things matter, like airplanes, the actual rides, customers going places with their families, or is it really just about what credit card people use and whether or not these companies are collecting enough fees to really support their sort of side project of flying people around?
Yeah, so, that's one of the things I think we're always trying to think about here at Bloomberg Intelligence, right? There's always this demand to use, the airline's credit card to get miles. I guess I wonder if that's the way Americans save for vacation. And so, I don't know, maybe they're less price sensitive because they're busy using that airline card day to day for, their food purchases and their fuel purchases. And then it comes to summer vacation and they just pull the points off it and don't care as much. I mean, again, the yield fare data we're getting tell us the consumer is price sensitive and is resisting higher prices, but there is a little bit of an inertia that's built in, I think, just from these airline credit cards. Some do it a lot better than others. Delta's the best, I think, in that space with their American Express partnership.
I wonder who Lisa flies with. George, I just want to quickly go back to Boeing for a second. We had an analyst come out and said, well, it could have been worse. Do you think we're past the bad news, past peak bad news when it comes to Boeing?
Look, I think a lot is predicated at Boeing on a second quarter recovery in the manufacturing process, in all of their facilities. I think if you remember when we entered this year, we were waiting for the Boeing recovery until all of a sudden a door panel came off an Alaska Airlines airplane. I guess what concerns me about Boeing is I feel like we're potentially bottoming with this problem. But if we have some other problem crop up that we're not thinking about, then we're back in the soup, I think. And so it feels like they're starting to get the bottom underneath them in the manufacturing, processes. But you got to start to deliver a bunch of airplanes through the factory that have the quality that's expected, I guess, before I'm ready to totally check that off the box. I hear management telling me things are getting better. I want to see airplanes going into the marketplace and customers happy about it.
So, George, every time you or any other analyst comes on and starts talking about engines and panels falling out and doors blowing out, we start to cringe and say, we're really sorry. We want to apologize. John does this all the time. If you're about to fly, please block your ears. Do we have any evidence that people are flying less frequently because of some of the safety concerns? Or is this just basically ongoing in the political and business sphere that hasn't really percolated down into consumer sentiment?
So I hear a lot of consumers ask me the question about if there's certain product I would fly or not fly. It's in the back of people's minds, but I get the sense that they're just driving on with life right now. And I think that's probably fair. I mean, the probabilities are very, very low. We haven't had any major accidents in a lot of years. Doesn't mean it couldn't happen, but I think it's just, you just drive on with life. I think, if you probably knew all the things they were repairing in your airplane before you left the stand, you might get a lot more concerned than you do normally. It's not a perfect business.
George, thank you, sir. George Ferguson there of Bloomberg. Nothing perfect about it, certainly this year so far. I've been checking. I didn't used to check, but I check now.
This is just Therapy Thursday.
There's a website, amiflyingaboeing.com. And you can check whether the flight you're scheduled for that day is a Boeing or not.
But what are you going to do with that? I mean, honestly, if you find out that you're going to be flying it, do you not go on your vacation with your friends or see your family?
Call your therapist. It's the Therapy
You
Thursday.
check before you book, don't you? That's the... Don't you do that?
I like George's. Right. You carry on. There are risks everywhere.
Sure. OK. Yes. From you. Yeah. OK. Carry on. There's risks everywhere. That's Bramo, by the way. Bramo.
Let's move on.
Does that apply to markets or no?
Look, just come on. Keep going.
OK.
Thank you.
All right, cool. Equity futures right now down by 0.7%. Let's set up the next 10 minutes or so. We'll be talking about US GDP and jobless claims. We'll be catching up with Blarina Urucci of T. Rowe Price right here to react to those numbers in just a moment. Mike McKee's going to break it all down for you. Bramo, this is it. Going into PCE tomorrow, the last big read of data going into next week.
And we've been asking all morning, and I think it's the question, which is, where is the bias right now in markets? Is it to more heavily weight a weak print or a strong print in terms of what that means for a Federal Reserve that I don't know if they've fully pivoted yet, but it does feel like, they're less willing to cut rates, but they still want to.
Can I say both? And I'll say why. Let's take CPI as an example. CPI comes in hot. It just reinforces the previous three prints, and everyone's like, oh, scary. They're not just bumps. CPI comes in soft, and everyone says, maybe this is the beginning of it. Let's start talking about rate cuts again. I think with that convictionless around this story, and to your point, it seems to change day to day, data point to data point. I think it doesn't matter one way or the other. It's just going to change the conversation just like that.
Well said, which is a reason why in 5 minutes you need to stick with us for us to break it down, because it's going to have a big market impact one way or another. I think that it's wise. It's basically everyone is so uncertain that they're willing to really push the needle significantly either way.
Everyone shouts shark and they run to one side of the boat and then to the other side of the boat. And,
That's a risk you're worried about.
Yes, sharks.
That's ridiculous.
Big on sharks. And bears too.
Okay, but
you're not scared of bears?
No, you just have to be
so
big.
many walking around New York City.
That's careless, Bramo.
Yeah, you carry bear spray.
Equities right now to Jackson Hole.
Yeah.
Every time.
That was ridiculous.
At the Fed show.
And
bear spray down in the corner.
And you're like staying in your room. You're not even hiking.
Because of the bears. It's a sensible thing to do.
Oh my God.
So much abuse in a commercial break, just for the record. Lisa's mum, Team Ferro, text in. True story.
She'll be
Team
happy.
Ferro, all right? Equity futures on the S&P, and thank you We're down about 0.7%. Near session lows, we're down 1 full percentage point on the NASDAQ. These are the scores going into US GDP on a 2-year, on a 10-year in the bond market. Yields look a little something like this. 493.52 at the front end. Yields up on a 10-year by a single basis point, 465.22. With the economic data, let's get to Mike McKee. Morning, Mike.
Good morning. Well, we're waiting for the GDP numbers to drop on the BEA's website. We can give you the initial jobless claims numbers, 207,000 last week. That's down from the initially reported 212. And continuing claims, 1,781,000, down from 1,812,000. So no economy is slowing. We need rate cuts story there. GDP comes in as a surprise. This one is one for the bears, guys. 1.6%. That is about half of the 3.4% that we saw in the fourth quarter, and it is also significantly lower than the 2.5% that was anticipated. We need to, at this point, look at what the issue was with that. Personal consumption, 2.5%. That's lower than the 3% that was anticipated, and so that may be something that we need to look into. There's what happened with consumer spending, because it had appeared very strong. The quarterly price indexes, 3.1% for the headline. That is up from 1.6%. It is a tick higher than the 3% that was forecast. And core is at 3.7% on a year-over-year basis, up from 2%. So that is higher than the 3.4% by a significant margin, 3.4% that was anticipated. So at this point, what we've got is a series of data points that say, no, the Fed does not need to be cutting rates at this point.
So, Mike, we'll turn to the boards and I'll get to the price action. And as we often say, this is the first move, and the first move is not always the right move, and we'll see if this sticks. But this is what it looks like. We're down about 1% on the S&P, down by 1.4% on the NASDAQ. Bear in mind, if you are just tuning in, there is a meta effect into all of this. We were down about 0.7 on the S&P 500 before the numbers. Looking at bond yields, we're actually climbing across the curve from the 2-year out to the 30-year by about 3 or 4 basis points. On a 10-year up by 4 to 468. On a 2-year up by 3 to 496. That's supportive of the US dollar. Dollar yen at about 155.62. My initial read on this, Lisa, and this could change in the next couple of minutes, of course. This looks like a read of what we're seeing on core PCE price index coming in a little bit hotter than expected. Jobless claims coming in a little bit lower than expected.
That seems to be clearly the read-through that at least people are settling on, though. If you watch the tape, they couldn't really make heads or tails of it at first because this is confusing data. You have, on one hand, a real question mark about why GDP didn't come in stronger, but then you have greater pricing pressure even without the personal consumption. It raises a lot of question. The jobs figures, if you say that that is the most reliable leading indicator, points to just ongoing strength, especially with those continuing claims coming in, going down to 1.78 million.
We'll talk lots more about GDP. Mike McKee's pouring over the numbers, and he'll explain what's underpinning that downside surprise on GDP. But claims 207. The estimate was 215. The previous week was 212, just much lower than anticipated once again. Mike, you've had a bit of time. What explains this one?
Well, it looks like consumer spending is the big issue at this point. Still driving down to find the inventory numbers, which make a big deal. The inventory is down by $19.5 billion. So that's one reason we're not seeing as much GDP as we had anticipated. The business fixed investment comes in higher than anticipated. So it looks like businesses were still spending some money, but it's goods spending that hurt consumers. A lot of that had to do with automobiles and gasoline prices, but services spending held up okay.
You know, Mike, I was saying this is kind of confusing number, and John rightly said that people probably are pointing more to the price index data coming in hotter than expected, so speaking to inflation, and then the jobless figure coming in lower than expected. How reliable is GDP data, considering the fact that it gets revised about 15 times?
Well, it gets revised officially 4 times. 2 more times it'll be revised. Then next year we get an update when they look through the tax data to kind of match it up. And then down the road after 5 years, they do it again. But what the Fed is looking at next week is this unrevised number, and it's what they have to go on. Now, when you look at GDP at 1.6%, that would suggest a real slowdown. But at the same time, we're getting these higher inflation numbers. So what is the Fed to make of this? We'll get some better data tomorrow with the PCE income and spending numbers and then the PCE inflation numbers. But when you look at this, if you were going to shorthand it, you'd say stagflation. But this is just one quarter's number. So we also have had a history of the first quarter being lower than in initial print and then being lower than the rest of the year. That didn't hold last year, but it has been sort of a pattern in the past.
Mike, if you strip out trade, is it actually a better report?
It could be. I haven't gotten all the trade numbers in there yet, but that could be. I'll find that out before we leave here. There's so much to this. I've been looking at all these different things here. Let's see. Trade.
Take your time, Mike McKee. You stay close. You work through those numbers.
You want to look at these charts.
I work through the price action.
Your eyes will...
We're down about 1% on the S&P 500 off the back of these figures. If you turn to the bond market, let's look at the 2-year, the 10-year and the 30-year. Initially, I think for a lot of us, didn't know what to do with this data. Yields are higher across the curve by 4 basis points on a 10-year, 467.70. On a 2-year, up by 5, approaching 5% all over again at 497.47. And with that, as you might expect, supporting the US dollar. Dollar yen still around 155, approaching now 156. Let's go through this economic data with Blarina Urucci of T. Rowe Price. She joins us now. Blarina, this is an interesting mix of data with the emphasis on interesting. You've got a big downside surprise on GDP. You've got core PCE price index quarter on quarter coming in a bit hotter than expected. Jobless claims a little bit lower than expected. Where would you place the emphasis this morning?
So I think it's very important to unpack the components of GDP and what led to this slowing in growth in Q1. So overall, I would say this is not a worrying report for the Fed. It's a report that says the economy continues to expand at a solid pace. Look at consumption growth at about 2.5%. This is a healthy consumer that is backed up by the claims data where unemployment claims are low and job growth remains strong when you look at the payroll data. So overall, it's a report that says to the Fed, the economy is not reaccelerating. It's slowing from the pace of growth in the second half of last year. That is telling the Fed that those interest rate increases may be having some effect in slowing demand, particularly for goods, but it's not alarming by any means. And then what I like to do with this GDP reports is to sort of look at the final domestic sales and final sales to domestic private actors in the economy. And that's showing 2.5% to 3.5% growth in Q1. It's not telling us that the economy is that weak after all. And I think a big drag here is also coming from net inventory contribution, which Michael already alluded to.
So we want to talk about the sustainability of this economic growth that we're seeing, because so many people are piling onto this story of US exceptionalism. Away from the top line number, which is a clear and obvious downside surprise, the sources of growth in the first quarter, Blarina, can we talk about that? Do you see that continuing through 2024?
Yeah, so there are a couple of interesting things here. Let's start with business investment. This has been driven by structures investment in the past and intellectual property investment as the housing market was really retrenching throughout 22 and 23 and res investment collapsed. Now we're seeing a rebound in res investment. And I think this is going to be sustained this year because there is really a dearth of housing in the housing market. We don't have inventory and home builders will start building again. And we're seeing that in Q1. So I think this will remain supportive of growth. Also, the point that we've made in the past together in this show is that I think the consumer, the US consumer, will continue to keep its wallet open so long as we don't have layoffs. And layoff data are not screaming weak signs now, and so long as we continue to add jobs. And then Michael McKee already discussed this problem of historical residual seasonality with Q1 GDP growth, which means that oftentimes Q1, also Q2 tends to be weaker than the second half of the year. So we need to be cautious of this as well. Now, the bigger question that I think you're also trying to allude to is, Where is potential growth for the economy? How fast can we grow beyond potential this year? And this is the big question mark this year because we don't know the effect of this shock to the labor supply from migrant workers that we received last year.
Blurina, the market seems to emphasize, as John was pointing out, the inflation figures as well as the jobless claims coming in lighter than expected. Is this what the Fed would focus on as well? Would they focus more on inflationary pressures than they would, say, on slowing growth?
What the Fed has told us is that they're not concerned about the strong growth numbers and the strong employment numbers, and their focus remains inflation. So in that sense, it makes sense. I think they'll look at the GDP numbers through this lens too. But at the same time, there is no new information really in the PCE deflator for Q1 because we've already received January and February data for PCE. We knew that that beat expectations. We largely have the components of March PCE because of the CPI reports and the PPI reports that we've received in recent weeks. And so I'm surprised that the market should focus so much on the Q1 GDP deflator because there's no new information there as far as I'm concerned.
Blurina, great to catch up with you. I just want to get a final question, if we can, looking ahead to the Federal Reserve next week. What is going to be the big topic of focus for you at that FOMC meeting? Do you expect any big changes to the statement at all?
So I would say that they want to be a little bit cautious about how sanguine they are on the number of cuts that they will be able to deliver this year, given the strength of economic data, the labor market, and the upside surprises to inflation. So I do think they will emphasize that they have a dovish bias, but it's uncertain whether they'll be able to deliver on that March SEP and the dot plot. So I'm watching for signs that they want to back off from 3 cuts this year.
Got it. Blurina, thank you. Blurina Urucci there of T. Rowe Price going into the Federal Reserve next Wednesday. Mike McKee, you've been waiting patiently. You've had a bit of time to go over this. What jumps out?
Well, Annmarie was right about trade. Trade subtracted about 0.8%. We had a big increase in imports and a very small increase in exports. So even with the strong dollar, it didn't help out a whole lot. Well, it maybe helps on the inflation side. Personal consumption, 2.5%. As Blurina said, it's not particularly bad. Business fixed investment, non-residential up 2.9%, down from 3.7%. Surprisingly, 2.1% increase in equipment, while structures went down. That's a reverse of the story we've been getting. They were building lots of factories with the CHIPS Act and the Inflation Reduction Act, and now it may be that they're starting to fill those up. Mentioned inventories change as an issue. And the one other thing that is interesting here is that the federal government spending was down by 0.2. First time it's been down since June of last year. 0.6 of national defense was down 0.6 national defense spending. And so you wonder if this is one of those things that it's a shift in timing because Congress didn't pass the Ukraine-Israel bill, which will spend a lot of that money in the United States rebuilding ammunition and stocks, that we'll see that come up later in the year and contribute to more growth. So if you're the Fed, you have to take all these little things into consideration. I might walk back the idea of stagflation and say this is kind of a statistically mixed report. So it doesn't necessarily say growth has slowed significantly and you need to react to that.
Well, let's talk about how this market is trading on the statistically what are you calling this? Mixed report? Okay, let's go with that. Equity futures on the S&P 500 down by more than 1%. We're negative by 1.16% on the S&P 500. Let's get up to speed with news elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Let's also get you a check on Southwest shares. Shares are down by 8% in the pre-market. It had a statement this morning that showed just how big of a toll the Boeing crisis is having on the industry as a whole. Southwest said that the growth is slowing. They'll have to end services at 4 airports, and they'll be limiting hire while also offering voluntary leave. Boeing has also said to only give them 20 737 MAX 8 planes this year, down from a planned 46. And it's smooth sailing for Royal Caribbean. How's that for a pun? Shares are higher by 2% pre-market. Earnings did beat, and it also upped its full-year profit forecast. Royal Caribbean said that demand for cruises is still surging, and now ticket prices are at an all-time high. maybe the Fed does need to hike. ESG funds, they were supposed to be the cash cow future of fund management, but now the category is in the middle of its worst ever outflows. Clients pulled $8.8 billion from ESG funds in the first quarter of the year, data from Morningstar show. It's a clear U.S.-Europe divide. Europe, for its part, still attracted $11 billion of inflows in the quarter. It also highlights a growing political sensitivity to strategies that Republicans have labeled as woke and anti-American. One strategist at Morningstar said that there was indeed increased caution ahead of the U.S. election. And that's your brief. John.
Danny, thank you very much. Strong feelings here about cruises. We'll save those thoughts for another time if you're not familiar with them.
Everyone knows.
Maybe some people don't. Up next on this program.
Big cruiser.
Looking ahead to the Fed's next meeting.
Whenever the Fed does cut, the market will price a lot more easing, but who knows when that happens to be. So committee members have to subscribe to the idea it's not just 1 or 2 cuts, it's probably 4 or 5 at a minimum.
That conversation up next from New York. This is Bloomberg. The S&P negative here by more than 1%. Bond yield shifting higher by 6 basis points now on a 10-year through 470. Kind of ignoring what we got on GDP. And Lisa, we said it initially when the numbers dropped. The focus seems to be on core PCE, on the quarter coming in hotter and claims coming in lower than expected.
Those speak to inflation, and it implies that people think the Fed is going to care more about the inflationary read in the sense that there is not any cracks in the labor market than they do a GDP print that came in softer than expected, but still points to growth.
The 2-year very close to 5%, 4.99. Under surveillance this morning, looking ahead to the Fed's next meeting.
If you think about the FOMC, when those committee members sign up for 1 cut, they have to assume there will be a bunch of cuts to follow. And my strongest view with respect to Fed policy hasn't changed. Whenever the Fed does cut, the market will price a lot more easing, but who knows when that happens to be. So committee members have to subscribe to the idea it's not just 1 or 2 cuts, it's probably 4 or 5 at a minimum.
Here's the latest. Investors looking ahead to the PCE data tomorrow morning following GDP. Just after 20 minutes ago or so, the Stifel chair and CEO, Ron Kruszewski, saying this: at the beginning of 2024, the market anticipated 6 to 7 rate cuts. Stifel was not in this camp, and we projected 2 to 3. We stand by this view, although 0 or 1 and even a rate increase could also be in the cards. Ron, I'm pleased to say it's with us now for more. Ron, wonderful to catch up with you, sir. I remember our conversation at the start of the year. The market was at something like 7, and you were talking to us about how bonkers that call actually was. You also said something interesting about coming out of this investment banking recession, so maybe we should start the conversation there. Do you believe that over the last 3 months you've seen more evidence of that? We're coming out of the other side.
For sure. As I said in Davos, though, I said that 24 would be a transition year, and I stand by that as well. But in our first quarter, we had our best capital raising for equities that we've had since the end of 2021. So certainly the market is improving, and we say that, but it's not a hockey stick.
How sustainable do you think the bounce is in deal making, in M&A, given that seemingly, apparently, with this government, with this regulator, you can't get a Tapestry Capri deal done? How are we going to get deals done in America in 24?
Well, that's the regulatory aspect is for sure something that deal makers are concerned about. I know the boards that I talk to, a risk factor, which is higher than it ever has been, is the risk of a transaction being held up in whatever agency decides to hold it up, Justice, EPA, you name it. But that said, the environment is improving for advisory M&A, strategic. There's a lot to do, a lot of things that companies are going to do, and I think the environment is improving.
The market is not the economy. And when we talk about the idea of the environment improving, it raises a question: does that suggest the economy is accelerating, or just simply that people have more conviction of where we're heading?
I would say the latter, that there's just more conviction. Certainly, when in the last year and a half, when you have the Fed aggressively raising rates and the uncertainty with that doesn't help. And today, at least, rates are stable, if not, projected to go down. We're not, I haven't been thinking the Fed's going to pivot fast since the beginning of the year. But the environment has a little more certainty than it did even a year ago.
You know, we're looking through this data, and it was confusing for us a little bit because we felt like the GDP number was expected to come in hotter, which would cohere with this idea of stickier price pressure that we could see in some of the PCE, the price index data that we also got. Jobless claims also coming in lower than expected. How much does this sort of cohere with what you're seeing among your own clientele, that price pressure still is the main pressure for them, and a lot of small businesses still are just hiring as many people as they can?
Well, for sure. I don't think the GDP report today was that meaningful one way or another. I think that the fact that we believe inflation is going to prove more sticky than it has, sticky for us would be that the Fed's preferred measure, which is core PCE, it may settle at 2.5 versus 2, and the Fed's not. I don't see why the Fed would be, rushing to be cutting rates into an environment where inflation is still sticky. That was true 3 months ago. It's true today.
If that's the case, what does this mean for regional banks and, frankly, all banks that are basically having to pay their depositors that much more to keep them in place? But longer term, when you look at those rates, they're below. You still see that inverted yield curve. At what point does that become punitive in a way that restricts business?
Well, I don't think an inverted yield curve is beneficial for banks for the reasons you just said. You're paying the highest relative to the curve for your short-term deposits. And the market is adjusting for loan demand, and the banks are adjusting to a higher rate environment. Overall, though, I believe loan demand is going to improve. And I think that over time, the yield curve will become certainly flat, if not somewhat inverted as we move into next year. And that's good for the banks.
A lot of uncertainties out there, pace of race cuts, there's geopolitical risks. Everyone's talking about this idea that maybe people are staying on the sidelines ahead of the election. When it comes to deal making, what are you seeing in the deal making space? Can we see a proper rebound?
Again, I think so. There are a lot of uncertainties. All that you just said, a lot will be resolved this year, beginning with the uncertainty in the U.S. presidential election. That which way that goes will certainly, I think its arguments would be on a Republican win would free up some of the regulatory burdens surrounding M&A today. And that we saw it in 2016, certainly with the banks. And I think you could see it again if that would happen. But there's I'm not making a presidential election. I'm just saying that the market, that uncertainty is weighing on the market a little bit.
But is that really correct? Because we heard from Senator J.D. Vance and a few other Republicans who actually praised the FTC's Lena Khan for how tough she's been when it comes to antitrust. And he's an individual that's on the former president's shortlist to be VP. So do you actually think we can see a change in regulation if we see a change at the White House?
Well, I think some of the praise, I might be wrong here, but some of the praise is surrounding big tech and the privacy and a lot of the, I think that's almost bipartisan. It's a popular thing to pile on to big tech today. So certainly, though, I wouldn't think that J.D. Vance would be saying that regional banks shouldn't be able to combine. I don't believe that at all. Maybe I'll have to call it.
Ron, just quickly, I want to ask this question directly of you. Did you release all your staff from non-competes this week? Did you listen to the regulator?
We don't have non-competes. You work at Stifel because you want to. If we do have anything, we have deferred comp that you have to do certain things to continue to vest. But one of them is that you can compete. That's the American way. So we didn't release people, so to speak, from non-competes.
Love that. Deferred comp's an even bigger trap, and we both know that. Ron, it's good to see you.
We do.
Great to catch
We
up. Steve was Ron Kosiewski there on non-competes, deal making, and investment banking in America.
Did you see Matt Levine's column?
What did he say?
It was great. He was talking about the big question is, if you have no non-competes, does that mean no gardening leave? And that's what people really care about, which is basically a paid 6 months vacation, because they do have non-disclosure as well as, of course, deferred compensation.
Deferred compensation, that's the trap. That's like,
the golden handcuffs.
Oh, without a doubt. Without a doubt. Equities right now, session lows down by 1.2%. Coming up tomorrow, Dan Ives of Wedbush, Mohit Mittal of PIMCO, Emily Rowland of John Hancock, and JP Morgan's Bruce Kasman. The data, GDP a bit softer, PCE a bit firmer, jobless claims a little bit lower. Put it all together, equities down, yields up.